Good morning to our listeners and viewers, and welcome to the fourth annual conference with licensed financial institutions. We'd now like to give our attention to C. Teresa Smith, the Director of the Research, Statistics, and Data Analytics Department, who has been assigned with the opening prayer.
Most gracious and Heavenly Father, we come before you this morning thanking you for life spared and for your many blessings, O Lord, in our life. We thank you, O Lord, for waking us. We thank you, O Lord, for giving us presence of mind. Heavenly Father, as we gather as an institution and as a grouping of licensed financial institutions for this, our fourth annual conference, we ask, O God, that you bless the proceedings. Bless the presenters, O Lord, the chairpersons, the moderator, all those who have had a hand, O Lord, in some form or fashion in these proceedings. We ask, O Lord, that as we discuss the matters at hand, we remember who we are serving, O Lord. Help us, O Lord, to, in our discussions, to advance the interests of our colleagues and our families and our community in the wider ECC. Heavenly Father, as we go forward, we ask you just to continue to guide us. Bless the homes from which we've come. Bless the departments, O Lord, and the institutions. These mercies we ask in your Son's precious name with thanksgiving. Amen.
This fourth annual conference with licensed financial institutions finds us at a very difficult juncture in world history. We are now experiencing significant economic, geopolitical, and environmental upheavals. And these events in themselves would have resulted in severe dislocations. But what we find now is a confluence of these issues that are affecting not only us here in the Eastern Caribbean Currency Union, but the entire globe. But to put these events in context, let's give our attention now to the governor as he begins with his opening remarks.
Thank you very much, Mr. Master of Ceremonies. Deputy Governor, Dr. Bala Henry. Chief Director for Policy, Ms. D. Tracy Pulias. Director for Financial Sector Supervision Department, Chris Luard. Director for Research, Statistics, and Data Analytics, Teresa Smith. Mr. Rob Phillips, President of the ECCB Bank Association. Other executive members, regulators, licensed financial institutions, moderators, panelists, members of the media, ECCB colleagues, citizens and residents, good morning, wherever you are in the currency union and around the world. I welcome each of you to our fourth annual conference with licensed financial institutions, and I thank you all for joining us today. It is our expectation that next year's conference will return to the ECCB campus, albeit with a virtual option to ensure maximum participation. The likely dates will be November 8th to 10th, 2023. Please insert in your schedules and make your travel arrangements early. The theme for this year's conference is an inflection point. What's ahead for the ECCU's financial landscape? Now, before I share a few thoughts on the theme, a word on our macroeconomic and financial environment. Today, I confirm that our EC dollar remains strong. I also confirm that the ECCU's financial system is broadly stable and sound, backed by adequate levels of capital and liquidity. Not one financial institution, LFI, has accessed ECCB's liquidity support facilities since the commencement of the pandemic. I commend our licensed financial institutions for your very good work in a very challenging environment. That includes the pandemic, record inflation, the acquisition of Canadian banking operations with attendant transition issues, and the implementation of prudential standards such as the treatment of impaired assets. Now, persistent inflation, the rising probability of a global recession in 2023, tightening global financial conditions, and continued geopolitical risk from the war in Ukraine do not bode well for our financial and economic outlook. In an attempt to get inflation under control, central banks in advanced economies will continue to raise interest rates. As a consequence, the global economy has slowed, and our major trading partners such as the UK and the USA are likely to experience a recession in 2023. In the ECCU, economic recovery is being propelled by a strong rebound in tourism. At this time, the ECCB does not project a recession in the ECCU in 2023. However, our current growth forecast of around 6% is likely to be lowered. Now, let me offer a brief perspective on the question of what's ahead for the ECCU's financial landscape. Our vision. Our vision for the ECCU financial system is a strong, resilient financial system, inclusive financial system in the ECCU. The details of the vision, here are some of the details for the vision going forward. We envision a financial stability framework inclusive of a regional standard-setting body for all financial regulators, be they bank or non-bank, regional or national. 2, the greening of our financial system. 3, a credit bureau. 4, a deposit insurance scheme to protect depositors. 5, an office for financial conduct to address market conduct. 6, a strong financial literacy, wellness, and resilience program. 7, a modern payment system and services framework. 8, a modern insolvency and bankruptcy framework. 9, a virtual assets business regulatory framework. And I want to tell you that our new strategic plan, ECCB's, is fully aligned with this vision. And much of our work in 2023 will be focusing on helping this vision I just articulated to become a reality. In the limited time at my disposal, I want to touch on 2 issues before I conclude. 1, financial stability, and 2, financial inclusion. Ladies and gentlemen, the climate crisis is real and poses an existential threat to our lives, livelihoods, and the way of life. By clear implication, climate risk is financial risk and directly impacts financial stability. I want to repeat that. Climate risk is financial risk. At 1.2 degrees Celsius above pre-industrial levels, our planet is evidencing the effects of global warming with extreme weather events, droughts, heavy and unseasonal rains, as well as higher frequency and ferocity of natural disasters. And by the way, in the Caribbean, the frequency of natural disasters in the Caribbean is 6-7 times higher than the global average. 7 times higher. And the damages and losses from these disasters is 6.5 times higher than the global average. What am I making? I'm making the point. We are extremely vulnerable to climatic risk. And as players in the financial system, we have to begin to seriously focus on this because it touches and concerns financial stability. Sea level rise has doubled since 1993, with 10% of that rise in the past 2.5 years alone. According to the World Meteorological Organization, the past 8 years have been the hottest on record. Ladies and gentlemen, the heat is on, and the race is on to save our planet. Before I continue, I wish to express our concern, sympathy, and solidarity with the people of St. Lucia and the Commonwealth of Dominica in respect of the loss of life and property occasioned by heavy rains last weekend. And it was not even a named storm. This week, Grenada and St. Kitts and Nevis were also impacted by heavy rains. Financial inclusion. As Ravi Menon, head of the Monetary Authority of Singapore, puts it, climate change is the mother of all supply chain shocks. I want to repeat that. Climate change is the mother of all supply chain shocks. Of necessity, then, the ECCB, as a responsible regulator, will work closely with licensed financial institutions to address climate risk. This will include the issuance of a standard in 2023 on climate risk, thereby providing guidance on disclosures, stress testing, and capital adequacy, as well as support for the development of a green finance market to help accelerate our renewable energy transition and increase our region's capacity for adaptation. Now, in terms of financial inclusion, when we speak of financial inclusion, we refer to access to payments, credit, and insurance for our people. Now, a basic requirement of financial inclusion is access to a bank account. Indeed, in some advanced economies, access to a basic bank account is protected by law. The current challenges with opening a bank account in the ECCU are unacceptable and must be urgently addressed. To that end, I have asked the ECCU Bankers Association to make proposals to our central bank on how we can ensure that citizens and residents of the ECCU have access to bank accounts while making the process of opening an account far easier than it is at the present time. In my humble estimation, we must do so while delivering on our AML-CFT commitments. This task is urgent, and I look forward to the submission of the ECCU Bankers Association in the first quarter of 2023. Now, next month, we will finally launch the long-awaited credit bureau in the ECCU. We are very excited about this development, as the credit bureau will strengthen credit risk management in the ECCU while also helping to expand credit. The evidence indicates wherever a credit bureau has been established, credit has increased. In respect of the partial credit guarantee, which we launched in October 2020, my latest numbers from the CEO indicates the following. There have been a total of 36 guarantees approved, totaling $3.2 million, and that's approved by the Eastern Caribbean Partial Credit Guarantee Corporation. The participating financial institutions are, in Antigua, Eastern Caribbean Amalgamated Bank, ECCB 3. In the Commonwealth of Dominica, National Bank of Dominica, NBD 7. In Grenada, Republic Bank 12. Grenada Cooperative Bank 1. Grenada Development Bank 1. In St. Lucia, Bank of St. Lucia 7. And St. Lucia Development Bank 5. Now the guarantee fund is $30 million, 30. I therefore urge all financial institutions to make greater and faster use of this program, aimed at making credit available to our small businesses, including women in business and creatives. The guarantee program supports loans of up to $750,000 with a guarantee of 80%. It offers 3 products: classic guarantee, startup capital, and working capital. By now, some of you may have heard of the Eastern Caribbean Securities Regulatory Commission's crowdfunding project. And this is also geared at increasing access to finance for MSMEs, small, micro, small, and medium enterprises in the ECCU. So let me now conclude. The post-COVID era in the ECCU must be marked by strong risk management in areas such as corporate governance, credit, cybersecurity, and climate. It must also be marked by innovation, with people, and I want to repeat this, with people at the center of our collective action. So when we discuss opening a bank account, it is putting people at the center of our financial system. We must fiercely protect and enhance the reputable brand of the ECCU's financial system. Indigenous banks, you now control 2/3 of all banking assets in the ECCU. And I remind you that when someone has been entrusted with much, even more will be required. Luke 12:48. I thank our panel chairs, presenters, and all those who will share ideas during this conference. I also express appreciation to the Research, Statistics, and Data Analytics Department, including Director Teresa Smith, Deputy Director Chanel Thompson, Waverly Paul, Kevin Woods, and everyone else from the department involved. And finally, I thank our Corporate Relations Department for once again rallying with us around this conference. And with that, I look forward to an excellent interchange over the next day or so, and of course, operationally tomorrow, and I thank you for your time and attention. God bless you all.
Thank you very much, Governor, for not only painting the backdrop in which all of these developments are occurring, but more importantly, outlining the proposed framework of policy responses in response to the current crisis. We now take this opportunity to introduce the crux of our conference this morning, and that is to introduce the panelists. But in order to do that, we would like to introduce Ms. D. Tracy Polias. She's the Chief Director of Policy at Eastern Caribbean Central Bank. Ms. Polias is going to not only introduce the panelists, but she will be also moderating that session. Ms. Polias, please.
Recording in progress.
Thank you very much, Mr. Chairman. Good morning, Governor, Deputy Governor, executives of our LFIs, management and staff of the Central Bank. Good morning. I welcome you to this panel on environmental risk and financial institutions. And Governor this morning underscored the importance of us looking at issues such as these. Just this weekend, we had 2 events, rainfall events in Dominica and St. Lucia, not named storms, but as a result of troughs. And therefore, it's important that financial institutions do accommodate environmental risk in the context of the management of their entities. Therefore, this morning, this panel is very timely, and we have a very strong panel today. First up, we have Ms. Naomi DeAli, Managing Director of Republic Bank, Grenada. We have also Ms. Shari Joseph, who works with the Financial Sector Supervision Department at the Eastern Caribbean Central Bank. And we have also Mr. Randy Graham, Chief Executive Officer of CG United Insurance Limited. We will start this morning with Ms. Naomi Deali, who is the Managing Director of Republic Grenada. This appointment started on April 1st, 2021, just about a year and a half into this appointment. She's a career banker with a wealth of experience in commercial credit, corporate credit, and risk management, with over 27 years of experience with the Republic Group. She's an associate of the Chartered Institute of Bankers. She holds a Bachelor of Science degree in Financial Services from the University of Manchester and a master's degree in finance from the University of London. She's held the position of General Manager, Credit and Enterprise at Republic Bank, Barbados Limited for 3 years before her secondment to Barbados, where she served as General Manager, Credit at Republic Bank Grenada for 5 years. She's also a member of the Caribbean Climate Smart Accelerators Financial Advisory Committee. Welcome, Ms. Deali.
Thank you, Tracy, and good morning to all. Thank you for inviting me to be part of this esteemed panel to discuss a very timely topic, as the governor and yourself said, environmental risk and financial institutions. Allow me to share my screen. And slide show now. Okay. Please confirm you're seeing my screen. Okay. So this morning, we are talking about environmental risk and why. Because we are risk managers. And when we look at this slide, from the World Economic Forum Global Risk Report, it highlights the green knobs, environmental risk, and shows that it dominates 5 among the top 10 risks by likelihood. And it's well represented in the top risks by impact. So that tells you that our conversation this morning on environmental risk is very important. As financial institutions, environmental risks impact us in several ways. And here I present 4 major risks, all possibly impacting value of assets on our balance sheets, or negatively impacting our clients and their ability to repay their obligations when due, or impacting our brand value due to negative publicity associated with poor environmental practices by clients. So very important to identify those risks. In recent years, we have observed a rise in sustainable businesses across the globe. Are we prepared or ready to offer similar value proposition to investors in that space, as the CEO of Hershey says? Sustainable business becoming a way of doing business, integrating sustainability into our core banking activity, and not just looking at business through traditional financial profit and loss lens, but through sustainability lens as well. Why is this important? Because here we see an interesting trend. Global sustainability market showing in 2021, the global market raised US $859 billion in ESG-linked capital. But what is expected by 2025? It's expected to exceed 53 trillion, 1/3 of all global investments. So hence, we must be resolved to enter that sustainability space to embrace the opportunities on offer. And so we ask the question, what is sustainable finance? It is a process of taking into account environmental, social, and governance considerations, or as we shorten it, ESG, when we make investment decisions. And that balance with ESG in the focal lens will give us long-term value creation. But we tend in the Caribbean to be very complacent regarding global emissions because to us, we're a tiny dot. We see in this slide here, we just contribute 0.3%, rank 37 in the world. However, while we are low contributors to global emission, we cannot ignore or remain oblivious to the state of the world's environment because we are part of planet Earth. So we must play our part by focusing on strategies that improve economic and societal resilience. That's the focus, resilience. So what's the focus for the Caribbean? We can look at several aspects in which where we could get involved in ESG activities. As we underwrite our loans, are we looking for opportunities to encourage our clients to be energy efficient by using LED rather than normal fluorescent bulbs? Are we investing in renewable energy generation? Are we encouraging our clients to construct eco-friendly buildings? Are we looking for opportunities to invest in agriculture projects that will be linked to food security and less importation of our food and more resilience? Resilient infrastructure, water conservation, all these are aspects for focus. Why not set aside targeted funding for capital investments towards food security or resilient housing or renewable energy generation? Can we incentivize our clients to center their projects or their business on sustainable practices by looking at a lower rate when they achieve certain benchmarks? Can we focus our CSR budget, corporate social responsibility budgets and activities along sustainable development goals, focus on creating partnership for sustainable environment and societies? This slide shows the stakeholders' opportunities before us. And note that financial institutions sit in the middle. And why? Because we tend to be that center for economic activity and the generation of wealth. Can we encourage our sovereign governments to start looking at sustainable bond issuance or climate resilient infrastructure development and support those endeavors by funding them? The utility providers, are we looking to encourage them to consider commercial RE installations or modernizing the generation and distribution assets so that we can encourage the general society towards greening the environment? Our manufacturers and hotels, especially in the ECCB or hotels, need to start considering when they build to be energy efficient, how they use water, the taps they install, the toilets they install, the sort of ACs they use, or the renewable solar panels that they can put on their roofs, their large roofs, to encourage decarbonization. And show them the benefit by using that in the advertisement, because discerning travelers are now looking for brands that are along the sustainable development track. Our SMEs, our retail markets, could be encouraged to look towards operational efficiency by looking at low-cost substitutes and using renewable systems to enhance their business and reduce their operating cost. All of this, if we do that well, then we can improve resilience, we can ensure stronger companies for the future generation, better governance and risk mitigation, and therefore long-term value creation. However, nothing comes easy, and embarking on an ESG progress has its challenges, and some are listed there. Worthy of note, some talk about lack of reporting standards and regulation or the complexity of those. As our regulator contemplates a suitable framework for our region, this aspect should be considered and managed. As financial institutions, we may be required to take baby steps first relative to meeting those applicable standards in that space. However, the rewards towards taking steps towards ESG integration is indeed rewarding. However, note that we must set the tone at the top. Senior leadership, the boards of members of the boards must be engaged in that tone at the top, that employee engagement, and engaging stakeholders such as shareholders and clients in that drive towards sustainable development. Establishing baselines across the organization on where we need to go, where we are and where we need to go, and then looking at ways we can track information, establish loan products and services that will encourage our clients towards greening the environment. Here is some best practices in finance, 5 of them, and it talks about internal risk assessment, lots of data required to ensure that we also encourage our clients to report to us how they are doing along the sustainability track. Measurement and tracking those initiatives. But one thing I want to highlight there is number 5, the creation of an ESG culture. And that cannot only remain in the business, it needs partnership. We want to encourage partnership, not only with our clients, but with the governments in the countries that we operate. Get to know more the national determined contributions, or NDCs, so that we can become partners in the endeavor towards sustainability. Why not consider, as we onboard mortgages and we underwrite these mortgages, coming up with a checklist towards climate smart practices and building and design. And when we track with the clients how they're doing and when they finally finish that project, then we could reward those clients by giving them a reduced interest rate for the life of the loan. When that continues to spread towards society, people will be thinking about resilient infrastructure, resilient residential and commercial buildings. So here are some ideas for exploration. One I really wanted to highlight here is an integration with the equity markets, securitization. I've seen one such project in Barbados when I was working there, where someone with large tracts of land, underutilized, no longer used for farming, decided to put down a huge solar farm. But he offered persons who did not have the opportunity to invest in renewable energy themselves to invest in his project by on-selling to them 5, 6, 10 panels based on what they could afford, and guaranteeing that the cash flow from those 6 or 10 panels comes to them as an investment. That then will utilize those deposits that we often complain as bankers, we have high liquidity in the system, utilize these deposits in generating additional income for persons and improving the lives of our citizens. Would we be willing to onboard such a risk onto our books to help to drive sustainability in our environment? That's food for thought for us. Each of us must play a part in that partnership. The Sustainable Development Goals number 17 speaks to partnership in the goals, and that calls for a holistic approach to onboarding risk that is properly managed so that we can encourage businesses, our clients, our governments, our stakeholders towards an environment that is sustainable and resilient to climate change. I thank you.
Thank you very much, Ms. Diali, for your very comprehensive presentation on environmental risk and how these dovetail into the whole environmental and social governance framework for our LFIs, and some very interesting ideas for exploration here. I will now turn to Ms. Shari Joseph, an examiner in our financial sector supervision department here. who works in the licensing unit, to give us her perspective on environmental risk and financial institutions. Shari holds a BSc in Economics and Accounting from the UWI and an MSc in Finance and Accounting from University of Westminster, London. Prior to joining the ECCB in November, she worked at the Macroeconomic Policy Unit of the Ministry of Finance, Grenada, for 7 years, where she served as Senior Policy Analyst and later acted as Chief Policy Analyst. During her tenure, she participated in the World Bank's Voice Secondment Program and has gained several certificates and training with the International Monetary Fund. Ms. Joseph also previously worked at the Grenada Cooperative Bank for 4 years, where she acquired an understanding of the banking system and gained experience in customer service. Ms. Joseph, welcome.
Thank you, Chief Director. Good morning, panelists, and good morning to all participants. Today, my presentation will be focused on climate-related financial risks in the Eastern Caribbean Currency Union and the work being undertaken by the ECCB to integrate climate-related financial risk in its supervisory framework. So the structure of my presentation today, firstly, I will highlight some key messages of the presentation, followed by an overview of climate risk. Then I will look at the implications of climate risk for the ECCU financial system. The importance of managing climate risk will also be highlighted, followed by what ECCB is currently doing and what will be done. And I will end the presentation with some final messages. Environmental risks are a significant concern for the ECCB and its member countries. It is necessary to assess the impact of environmental risk on the financial system and include these risks in the risk management framework. The ECCB will work with the licensed financial institutions to ensure that these risks are included in the framework to enhance financial stability. Environmental risks. Environmental risks relate primarily to the likelihood of an adverse consequence or threat of a negative effect on the operations of a firm and its wider environment due to a natural disasters such as floods, storms, or hurricanes. Global warming has led to more intense climatic events globally, increase in sea level, increase in temperature, changes in precipitation patterns may cause floods and may increase the frequency and magnitude of hurricanes. And in our region, we're highly vulnerable to climate-related hazards. Now, with these climate-related hazards, there are climate risks, which forms part of environmental risk. And on the climate risk, you have two types of risk. You have physical risk and you have transition risk. The physical risks are defined as a risk from the damage to physical assets as a result of an extreme weather event, while transition risks are the risks related to the process of adjustment to a low-carbon economy. And in our region, we are more susceptible to physical risk. Climate-related events will impact our real economy. Such an event can impact the economy by increase in infrastructure and service costs, disruption in supply chain, and decreased food production. Now, the impact on the real economy will trickle into our financial sector, and it can have an impact on our financial sector. Now, in our financial system, there is a lot at risk. The value at risk of assets in sectors that we deem vulnerable, such as agriculture, construction. So the value at risk for these sectors is estimated at $23.4 billion as at the end of March 2022. So therefore, it means that a growth in the banking sector will be, it means that there will be a growth in the assets, which means that there will be more assets at risk. Now, any adverse impact from climate-related financial risk can have serious implications on our institutions. There can be a deterioration of credit portfolios, especially for highly vulnerable sectors, which I would have mentioned before. There can be delays in receipt of insurance settlements. And then there's operational risk, which can be triggered by delays in the resumption of regular operations by the bank's clients and also by the bank. Then there is a loss of employment. That is another factor that can heighten the risk to our financial system, because with the loss of employment, then persons will not be able to pay their loans. Additionally, after a climate event, significant amounts of additional provisioning will be required, and this can impact the bank's profitability. Also impacting the bank's profitability will be losses incurred by the financial institutions because of the climate event. The inability of insurance companies to honor insurance settlements with the institutions in respect to their own properties and that of their clients can also affect the system. And then ultimately, there will be implications for the capital adequacy of the licensed financial institutions. So now that we are more aware of the effects that a climate event can have on our financial institutions, the question is, what can financial institutions do to mitigate the impact of climate risk in the financial sector? So the first thing that the institution can do is to ensure that the assessment of climate-related financial risk are included in the strategic objectives. And they will have to create a roadmap to show how they will achieve that objective. Additionally, dedicated human resources. This aspect, the assessment of climate risk in the framework, is new. So then you need, as institutions, will need to dedicate a specific team to assess these climate risks. The team can be part of any department, but what will be important is to ensure that there is someone that is looking at the assessment of climate-related risks. Then we have the risk management frameworks. Institutions will need to incorporate climate and environmental risk drivers so as to appropriately capture the risk. Also, institutions will be expected to publish material information and key metrics on climate and environmental risk, and this will demonstrate their responsibility and foresight in the institution's consideration of climate issues. The ECCB, as a regulator, also has a part to play in the inclusion of climate-related financial risk in the supervisory framework. The ECCB's strategic initiatives are mainly geared towards developing and implementing a climate risk regulatory and supervisory framework for the licensed financial institutions. The ECCB has already included climate risk in its strategic objective, and their strategic objective is to enhance the supervisory framework by the 31st of March 2023 to incorporate the assessment of climate risk. And the ECCB has been very proactive in this regard. We have partnered with various institutions to bring training to the national regulators, the licensed financial institutions, and our staff. The ECCB's initiatives also include technical assistance towards the development, execution of a roadmap or strategy, support in conducting feasibility testing, and precautionary risk protection measures against climate change, support in designing bank-specific climate change stress tests, and activities regarding climate risk disclosures. Other steps that the ECCB will be taking includes the promotion of the relevance of climate-related financial risk. The constant dialogue between the institutions will help them to make a better informed decision and also help with the capacity building. Within the first quarter of this year, the ECCB would have issued a climate risk survey to our licensed financial institutions. The survey was aimed at assessing the level of readiness of our institutions, the assistance that they may need for the institution to effectively evaluate, manage, and monitor climate-related risk, to ascertain the adequacy of the risk management framework and capital support, and to inform policy decision making on the development of an appropriate climate risk framework for the ECCU. Now, the results of the survey would have highlighted the willingness of the institutions to include climate risk in their management framework, and it also highlighted the need for capacity building. To effectively assess these risks, data will have to be collected. The data collection process has commenced, and the data being collated includes loan portfolio, balance sheet information, and investment portfolio. And all of the information will be critical to the assessment. And the data will also help us to analyze the effects of a climate event on the institution financials. And the ECCB is working with a consultant to conduct this analysis. And at the end of it, there will be a template that the institutions will use to report their climate risk. Prudential standard. There will be a prudential standard that will be issued, and the standard will be used as a guide to the institutions on what the ECCB expects of management to climate risk. And the standard is currently in the draft stage. And at the end, a risk-based supervision for climate risk will be developed and implemented over a 2-year period. So in conclusion, what will be important to remember is that the supervision of climate-related financial risk is developing globally. However, there are fundamental challenges that remain, challenges such as the lack of institutional knowledge that is due to limited personnel within the ECCU. Then there is the challenge of data collection. We have to ensure that the data that we collect is relevant. And also another challenge, it will be settling on an acceptable risk management methodology. Now, the ECCB, we oversee or we regulate 28 licensed commercial banks and 8 non-bank financial institutions across 8 countries. Now, the effect of our climate change will be similar but different for each country. So then the development of a risk management methodology that is applicable to all institutions will be challenging given the intricacies of each jurisdiction. And finally, another challenge that we'd like to mention would be the increase in capital requirements. Now, the new supervisory approach may require our financial institutions to reserve more capital to mitigate the loss associated with capital-related risk. And some institutions may be challenged in raising the required capital due to certain market conditions. Additionally, the amount of capital to be reserved has to be practicable for all institutions. So hence, capturing these risks are important. The inclusion of climate risk in our regulatory framework will ensure the continued soundness of financial system and improve its efficiency. Climate change will impact the operations and finances of our financial institutions. And given our region's vulnerability to natural disasters, building resilience is essential and must be part of policies going forward. Our new supervisory approach embraces the assessment of climate-related risks, and we are committed to working with our institutions to see this new approach to fruition. I thank you.
Thank you very much, Ms. Joseph, for this update on the work that is being conducted within the Financial Sector Supervision Department on supervisory approaches to climate risk. This, of course, gives our LFIs a little heads up in terms of where we are and our thinking on these issues. And I am sure it opens the the dialogue in terms of their conversations with us about how we move forward with this. Next up is Mr. Randy Graham he is CEO of the CG United Insurance Limited. Mr. Graham is the CEO of CG United Insurance Limited, and it is an insurance company which operates in 20 countries across the Caribbean. He is responsible for the strategic vision of the company and is charged with achieving optimum profitability results for shareholders. He has oversight over 250 staff members and knows them by first name as he strives to ensure staff are empowered and grow with the company. He was previously the Chief Executive Officer of the Financial Services Commission in Barbados. He has also served as the Director of Insurance and Pensions at FSC, a post that replaced the former Supervisor of Insurance. As CEO, Graham was responsible for much of the setup for the organization, which is one of the first integrated regulatory bodies which was established to regulate and monitor the non-bank financial system, inclusive of the insurance, pensions, credit unions, and securities sectors. Mr. Graham was formerly General Manager of Insurance Management and Professional Services, a local insurance brokerage firm. He is a trained risk manager and also lectures at the University of the West Indies, Cave Hill School of Business, the Insurance Institute, and the Credit Union League in risk management, investment analysis, portfolio management, managerial finance, and international business. He has conducted several insurance-related training seminars across the Caribbean and is a highly sought-after public speaker. Mr. Graham graduated summa cum laude from Southwest Missouri State University with a degree in insurance. He also holds a Master of Science degree in risk management from St. John's University in New York. His awards and scholarships include the Spencer Education Fund Scholarship, St. John's University Graduate Research Grant, and the Dean's Distinguished Scholar Award. He was the first person in Barbados to receive the designation of a Barbados Chartered Insurer. Mr. Graham has several executive leadership roles in organizations and has sat on several boards as a director of both local and regional associations. He's married and his wife Maria, and they have one daughter and one son. Welcome, Mr. Graham.
Thank you so much, and thank you for the ECCB's kind invitation to this presentation. Shari has spoken so eloquently before me. I hope that I can add some value to the presentation this morning, but I have a short presentation set up covering the impacts of climate and environmental risks on the insurance sector. And the insurance sector is certainly happy to be at the table in this discussion. And many thanks to Ms. Rose Providence and Mr. Thompson for making this happen. So as I said, it's a short presentation. It's at a high level because for two reasons. I think that ECCB has a very good research department that probably has a lot better statistics than I have in the first instance. In the second instance, I think part of this panel is to open up the thought process for conversations in the question and answer sessions to come after. So I will attempt to be mercifully brief in my presentation so we can get to the Q&A. So just in terms of this particular session and how it is set up, I'm going to try to focus in on the climate change itself and how that impacts the Caribbean and specifically hurricanes in the Caribbean. Also look at the environmental risks and what that means for us in the Caribbean as it relates to foreign currency availability and reinsurance. And then finally, just touch a little bit on inflation and how that's impacting the insurance sector. So these concepts are all concepts that can be relayed directly to us as Caribbean societies, but also as individuals living in the Caribbean. We feel the impacts of these. So I'm going to attempt to connect the dots between some of these macro, economic issues and insurance in the Caribbean in this short presentation. Now, first of all, I am by no means a geography expert. and I don't have the backing to tell you exactly how hurricanes work, but I thought these two slides were very useful in giving context to what we mean when we say climate change, and what we mean when it says is impacting the Caribbean. So on the first side there, we are showing the sort of a world map, if you want, and the areas in orange are the areas where hurricanes impact, right? And you can see there's a hurricane impact directly in the Caribbean region. So I'm not going to point fingers at anyone, country, territory, or otherwise, but just to say that, I mean, you can make your own judgments. There are orange areas here that get hurricanes, and then there are areas in blue and green that don't, right? They're not impacted in the same way. So when we talk about hurricanes having a direct impact on the Caribbean, on small economies, on vulnerable nations, we are not trying to say that the Caribbean, for whatever reason, the countries in the Caribbean should be treated any differently. I mean, this is not by our design. This is the world design. The world has designed it that the orange areas where hurricanes occur happen to come straight to the Caribbean. So you sit in North America, South America, Europe, and hurricanes may not be something that comes front of mind for you because you're not impacted by them. But we live in a belt where hurricanes form directly every year, and not by our own design. These hurricanes form. So we have to be intimately aware of the hurricane season. We have to be intimately aware of what the hurricanes are and what impacts those hurricanes because of the belt that we lay in, right? Now, on the graph on the right with A and B is sort of giving context to how a hurricane forms. So if you contemplate it, I mean, the waters in the ocean carry heat, right? The water absorbs the heat. That heat, when warm enough, obviously causes evaporations by our basic physics that we learn at school. The water temperature rises, the water evaporates, it rises into the air, forms condensation. When it cools, it falls, and that circulation of warm air rising and cool air falling forms the basis of why we have hurricanes. Now, global warming. And everybody's, I'm not saying whether there is or there isn't global warming, that's not my area. I'm just saying that if there is global warming and the world is getting warmer, the oceans absorb more of that heat. And the heat absorbed in the water means that the waters are warmer and the air becomes more violent. I mean, for those of us who spend any time at all in the kitchen, if you put a pot on to boil water and the heat is on low, eventually the water will boil. But if you think about the cover on that pot, it's not going to be jumping up and down violently if you have the stove on low. However, if you turn the stove up to high and there's a bigger fire, the water gets hotter and the cover on that pot will jump more violently because of the heat of the water. It is the same concept for hurricane. If the waters are warmer, you get more evaporation, more condensation, more cooling. You get a bigger hurricane. You get a stronger hurricane. In the same way, you get a stronger violent jumping of the pot on one warmer, right? So again, not to pick our point, but when you sit in areas that are blue and green on our map, and you heat the earth with global warming, you may not feel the impact, but we feel the impact in the orange areas because that water absorbs the additional heat from global warming. They become more violent, and then what we find, what we are finding is that is creating, stronger, bigger, and more frequent hurricanes coming through our belt. So it's not impacting places where it's blue and green, make your own call, but blue and green are creating global warming, and orange is where we are feeling it. So for us in the Caribbean, how is that playing out? So this is a bit of a historical list of Category 5 hurricanes, right? Category 5 hurricanes are the strongest hurricanes on record. They are the most devastating in terms of winds, well up to 100, well over in excess of 100, 150 miles an hour wind on a consistent basis. These are the ones that we are most worried about. And if you look in the history from this one carries us from 1924. up to 1988, where we have Gilbert, who many of us will remember. They are not annual. The Category 5 hurricanes are not listed annual. They're not frequent. We don't have one every year. This is when the Earth was they tell us the Earth was cooler in these times, and while the Earth is cooler in these times, we have a situation where we are not getting as frequent hurricanes as we would have seen. Now, if you move forward to 2016 to 2019, where we are seeing more frequent hurricanes. In the 2016 to 2019 period, you are now seeing hurricanes, a Category 5 hurricanes, bigger, stronger hurricanes happening almost every year. Some 2017, 2019, there were two of them in a year. So what we are saying, as a Caribbean, is that the global warming is causing Category 5 hurricanes, bigger, stronger hurricanes, to occur more frequently, and they're coming to the Caribbean region, which is the orange region, and that's why we are concerned with global warming, because those hurricanes are more dangerous and they're more prevalent due to global warming. And you can make your own conclusions based on the correlation between the Earth becoming warmer with global warming and the frequency of those Category 5 hurricanes relative to the frequency of the Category 5 hurricanes in the past when the Earth was relatively cooler. So that's the first concept I just wanted to touch on. Maybe we can, if there are questions, we do have the Q&A session after, but that's the first concept I want to touch on. The second concept I want to touch on relates directly to how insurance operates in the Caribbean. So we have various insurance companies operating in the Caribbean. We all are regulated, and we all have regulatory capital that we have to establish, as well as capital that companies would have built up over the years to enable us to offer insurance policies to our clients in the Caribbean and cover their property with confidence, right? And that's what we do. Now, in terms of the capital base that insurance companies have, we are small economies, so we don't have massive amounts of capital. So in effect, if to enable an insurance company to insure property in the Caribbean, we are very heavily dependent on our ability to buy reinsurance, right? So in real terms, many insurance companies in the Caribbean have a capital base of X dollars, but we insure houses and commercial buildings whose total value are 50, sometimes 100 times of the capital base that we have. As a very simple numerical example, if you have a capital base as an insurance company of $20 million, your total clientele may actually have buildings valued at 1 billion, right? So you are insuring multiple times of your capital base. The only way this becomes feasible for us to do, and the only way that we can give our clients confidence that in an event we will be able to to pay their claims, is if the insurance company purchases reinsurance, often from European or US markets. And that's how we operate, right? Many of us, if not all the insurance companies operate with such an issue. Now, how does this impact us? So what happens is you have global warming, you get more frequent hurricanes, you get more losses more frequently in the Caribbean, and then these reinsurance companies say, well, hang on, it seems as though the Caribbean is a hot spot, and we're getting losses every year. So we don't want to put our reinsurance capital in the Caribbean anymore. We're going to use our capital and offer the reinsurance in the US or Europe or other places. We're going to pull our reinsurance capacity out of the Caribbean. Now, please understand that if reinsurance companies pull out of the Caribbean, none of us as insurance companies can offer you cover on a normal basis, right? We cannot do it on the strength of our own balance sheets. We need the reinsurance. So if global warming is causing more frequent damage in the Caribbean, and reinsurance companies are saying that the Caribbean is no longer a good place to do business because of the frequency of the hurricanes, and that capacity leaves the Caribbean, insurance companies in the Caribbean cannot operate in the way that we have done in the past. So for all of these years, we have been fine. Reinsurance capacity has been in the Caribbean. We have no problem insuring. We have no problem repaying claims after a hurricane in the normal circumstances. Global warming comes around. We have an increase in Cat 5 hurricanes. We have an increase in damage. We have an increase in our claims having to be settled from these hurricanes. You now have reinsurance companies saying, hang on, we don't know if the Caribbean is a good place to be. That directly impacts us because we cannot, in good conscience, sell you your insurance policy without the backing of reinsurance. And so that will impact our ability to offer insurance in the region, right? So you ask, how does the environmental impact directly on insurance companies? This is it. If the reinsurance capacity pulls out, we will not be able to offer you insurance policies in the Caribbean. So we need the reinsurance capacity. So global warming needs to be corrected to slow down the frequency and strength of catastrophes. That is what is necessary for us to be able to continue to trade forward with the use of reinsurance. And that's the second concept that I sort of wanted to frame up in the presentation. Now the last thing that I wanted to deal with, well, they're two combined. One is foreign currency, and one is a bit of inflation. But just on the foreign policy, I heard earlier it spoke about the currencies that we have in the Caribbean. Just to say again that we are dependent on the reinsurance. We have to pay that reinsurance in U.S. currency. So if there is if you don't have investors coming into the Caribbean that allows the central banks to have adequacy of U.S. currency to give us to pay the reinsurers, this also continues to be an issue. So we need the Caribbean to remain attractive to foreign direct investment that brings U.S. currency, that brings tourism and other ways of currency into the Caribbean, so that our central banks have access to the U.S. currency for us to be able to pay our reinsurance, because it gets back to the same concept. We can't pay our reinsurance bills, and the capacity pulls out, and we have challenges with with trading forward as normal. And then the last point I just want to touch on again quickly to make sure that we stay on time and get appropriately to our question and answers is this issue of inflation. The governor rightfully made the point at the beginning of the presentation that one of the greatest issues and risks to environment that environmental risk brings is to the supply chain. We saw it when we had blockages of certain canals with accidents. We saw it when we had the Russian war. We understood after the war how much of the supply chains was related to countries that we would not have thought about in the past. All of these issues, even when there's hurricanes disrupting Miami and our transshipment there, show us that the cost of inputs, either by freight or otherwise, have carried up the cost or the impact of inflation, I should say, on the cost of items in the Caribbean. How does that impact you? How does it impact me? How does it impact insurance companies? Well, we insure our houses on a fixed sum insured. Just briefly, if you think about your own house, imagine your own house. You built your house, for example, in 2010. That cost you $200,000 to build the house back in 2010. You have insured your house for $200,000, and that's what your insurance policy is for, which is fine. And we have that policy in place. You've done well, and you've insured your property. If there's a hurricane and your house is damaged in 2022, now 12 years later, there is every likelihood that inflation now means that to rebuild your house, it will cost you to rebuild the same house, same size, everything, $400,000, right? So it's now doubling your costs, right? So you've insured it for $200,000, but the impact of inflation to get concrete, to get blocks, to get building materials into the Caribbean region, inflation has doubled the cost of these things. Therefore, to rebuild your same house after a hurricane, it is now $400,000. Even if you did well in insuring your house, it now creates a funding gap. You have an insurance policy for $200,000, but you need $400,000 to rebuild your house after a hurricane. You have a shortfall of $200,000 that we don't know where that money is going to come from. even with the use of insurance, the impact of inflation creates a funding gap in rebuilding of infrastructure in the Caribbean. If you do not keep the value of your insurance moving in line with inflation. So as inflation gets out of hand, so too the rebuilding costs, and we have this specific challenge, right? And that's one challenge, the funding gap. The second challenge is that, many properties in the Caribbean unfortunately still remain uninsured. So here it speaks to a 2015 report where 70% of the property in the Caribbean remain uninsured. So far away now from your situation where your own house is $200,000 short in rebuild. Imagine the property that has no insurance. They have a complete funding gap. How is that funding after the hurricane goes through? This is the challenge that we are faced with. Caribbean governments are often asked to come to the aid as a lender of last resort when we have damages. And it's unfortunate because our governments have so much to do. Making access to funding to rebuild is not what we're really setting up our finances to do. Insurance is probably a better place for diversifying that risk. But we do have the funding gap caused by inflation. And it's not just property, it's cars as well. To repair your car now costs so much more because of the inflation of these car parts. So the reinsurance, the cost of the parts and the inflation is really impacting how we operate as an insurance company. And as time is getting short, the last thing I will close with. In 2017, most unfortunate Hurricane Maria and Irma impacted Dominica. At the time, since that has passed, our research has said to us that damage caused by that hurricane in Dominica in 2017 was about US 930 million, or EC $2.5 billion in damage from that hurricane in 2017. Now imagine a situation where inflation has us with a funding gap of 50% of that, or worse, 70% of that value was not insured. It leaves 500 million US in property damage that we have no funding solution for. And that is, a real impact for Caribbean economies, both from the environmental risk and from the inflationary impact that we have to consider. We have to deal with the funding gap so that our economies or our countries can respond quicker, faster, and with better access to financing after a hurricane. So I think that those are the 3 points I wanted to cover very briefly in the presentation. And it's probably best suited for me now to bring this to a close and allow the ECCB to carry on with the question and answer to see if we can add anything further. But I thank you for your time and for your attention.
Thank you very much, Mr. Graham, for this very interesting exploration on the insurance dynamics and environmental risk and ESG, in particularly highlighting the challenge of reinsurance, which is outside of our control, the increasing cost and reducing capacity to the region, as well as the impact, the nexus between foreign exchange constraints in acquiring that capacity, and the link between supply chain disruptions and inflation dynamics, and the implications for building back better after an event, a climate event. I think these are very important issues. I would like to, on behalf of the bank, thank all the presenters. And we now open the floor for any questions. The questions will be displayed on the screen. They will come in virtually and be displayed on the screen. They will be read out in some instances, and we will address them to the presenters. So over to you, Elizabeth, if there are any at this time. I'm told that there are no questions at this time? Oh, there are 2. So let's just allow some time to get them on screen. While we wait, would any of the presenters like to expand on any of the points that they did not have enough time to highlight? One of the things I found very interesting from the presentation, which I think has not, in the context of even the discussions at COP26 that has not been highlighted significantly, is the issue that Randy would have raised about the increasing reinsurance capacity, the increasing cost of reinsurance and the reducing capacity for the region, and wondering whether this is a matter that will be placed on the agenda by our policymakers in terms of, so that when we negotiate in the context of COP, we could be looking for support or funding to sort of help with that gap. I thought that was an interesting matter and something that should really be placed on the policy agenda. Is there any presenter, or I'm not sure if Randy would like to expand on this, if he has time at this moment?
Yeah, no, sure, happy to do so. That's a very interesting and pertinent point. I think that it's right for discussion in many respects. So on 2 points, you're right. I mean, we in the Caribbean are at the back end of global warming, and we are receiving the hurricanes, but we are not creating the warming that's increasing the strength of the hurricanes. There are many a reason why capital, reinsurance capital, and other capital should be directed to small, medium-sized economies in the Caribbean to assist with some of the offset of the reinsurance costs that is coming along with the increase in hurricanes. Funds, really should be made available to the Caribbean. In some cases, as part of reinsurance, but also in some cases as part of low-cost funding to rebuild, because of the increasing strength of the hurricanes relating to global warming. And I'm sure there's research that shows a weaker hurricane going to the Caribbean is not what we are concerned about. It's these Cat 4 and Cat 5 monsters that are being created by global warming. And we should be able to have discussions with some of the other countries, as well as some of the reinsurance companies, about setting up a fund specifically for damage in the Caribbean that could assist. In addition to how we have the Caribbean Catastrophe Reinsurance Fund, we should have cells set up specifically for the Caribbean. So I agree with your point. Happy to be a part of that in any one vein. But I think it's a very interesting topic that you raised. I want that's open for discussion.
Thank you very much, Randy. We have our first question. Homeowners may be largely uninsured because of the cost of insurance. How can it be made more affordable?
Yeah, I don't mind taking that one. It's a great question. So, what we have seen in many insurance sort of studies is that society has said that, right? The disposable income is predominantly used up for the purchase of key consumables, right? Food, water, rent, gas. Insurance is not among the top priorities in that spend. So when we look at what's left on the disposable income, insurance itself in some instances may not be a massive dollar amount, but the percentage of insurance relative to the percentage of disposable income is too high, right? And that's why some persons, depending on their backgrounds, are not able to insure at the level that they would like because of the cost, which is a reasonable point. So I think in the future, what we as an industry have to do is look to create products that are specifically targeted to catastrophe response as a product in itself that is more affordable. So for example, a traditional homeowners policy will cover you for hurricane, but it also includes coverage for fire, burglary, vandalism, a number of other things that are all costed into that product. If that product itself is too expensive, what we need to do is separate out the product of response to hurricanes, for example, to make it simpler product with specific response to hurricane or fire, specifically that is more price affordable. And I think that is where the industry will look to go next, to make sure that every person living in the Caribbean can insure some form of insurance on their property for catastrophic events. So that, I think, is where we need to move to, either by a separated policy or by a policy based on a parametric model looking specifically at hurricanes or natural catastrophes, and maybe stripping out the other products that are not costed, making insurance more affordable for a wider part of the a wider segment of our society.
Thank you very much, Randy. I think this next question goes to you as well. Moving insurance coverage to the level of inflation, how would you recommend citizens do so? And the person posing the question is suggesting that most vulnerable persons would not be able to pay higher premiums. So I think this is related to the first question that you would have answered.
Sure. So I'll deal with both parts of it. So in terms, first of all, of the how do you keep your value in line with inflation? So the simplest way for a property, for example, to keep your property in line with inflation is to look at the value of the rebuild value of your house every year. Does not necessarily mean you have to pay for a property valuation. There are a couple of areas. So one, in some countries, you do get land tax valuations that give an insight to the value, the upgraded value of your property annually. But in the second instance, our manufacturing and construction sectors tend to have a benchmark for the cost of rebuild every year by square foot. So they may say, rebuilding costs in Dominica per square foot of a concrete block is now 200 EC per square foot, or rebuilding costs in Antigua for timber structures is now $100 per square foot. So you can get the rebuilding costs in your country, you can get the square foot of your property, and every year I would suggest you do this exercise of looking at the rebuild cost times the square foot of your property. And comparing that rebuild value to what you have your insurance of. That's the simplest way of keeping your insurable value close to what the rebuild value would be, so you don't have this funding gap if there's an unfortunate event. No, the amount of cost is the same, right? I agree. If you do get the increasing cost and we have the increasing cost of insurance as a percentage of your disposable income becoming a challenge, then we are back to getting the product itself more affordable. Now, there obviously are financing opportunities here where you can take your insurance premium and have it financed through a bank or other intermediary to pay over 12 months, as opposed to having to pay in 1 to 3, 2 or 3 periods. That makes it more affordable on a monthly basis. So I think those are the two options that we can look at implementing, right? So I don't like to talk about things that will take research. I'm talking about what can be done, what you can do tomorrow, right? You can look for a product that is more cost effective by stripping out the other elements, or you can go and seek a 12-month payment of your premium, and that's something that we can do tomorrow. In addition to having a basic review of your per cost square foot rebuild and the square footage of your building, these are things that I think we can do in the Caribbean to keep the values close, but also to make insurance more affordable.
Thank you very much. I'm not sure we have any questions now, so I will use the, we have one. A change in the risk culture of banks in the region will be key to the growth of the ESG sector, or to improvement in ESG, I imagine. What measures will the banks implement to provide the right incentives to encourage investment in renewables or anything related to improved environmental and social governance? I think that question would go to...
I could take that.
Yes,
one.
yes.
Sure, I'll answer that one. Banks do need to adjust their risk appetite in order to encourage clients to onboard these new products and services related to ESG. For instance, investment in renewable energy, solar panels, solar system. And that requires some training of the credit personnel because it's a new sector, a new field, and so intense training as to how you assess a proposal dealing with investment in renewable energy. But as I said earlier, we do need partnerships. We can't, adjusting the risk appetite alone would not encourage customers to onboard. We have to look at government tax incentives for importing the panels and the inverters. And so it has to be attractive in terms of the cost to the homeowner or the owner of the commercial property. As well, we do need reliable regulatory framework. So the regulators who have to extend the license to that homeowner, fixing the price for short periods like 5 years does not make sense, as we have seen in some, in the case of some countries. And some would give you a license as long as 20 years. In that way, the price is predictable, is fixed. Persons could look at when they would get the return on their investments and they feel comfortable in investing in a renewable energy system in that framework. So we cannot do it alone. Yes, there's a willingness to relax risk appetite, lower the interest rate, ring fence capital geared towards ESG activities, but partnership with regulators, with government, as well as intense advertising and raising awareness of our clients that this is available. Because it's new, many persons do not fully understand how they can benefit. I particularly said to my team, anybody approaching retirement in the next 5 years ought to be approaching us to put on a renewable energy loan onto the books, probably adding it to the mortgage so that it doesn't cause a big bump in the monthly payment. Because when you retire and your funds and your available cash flow has been reduced, then not having a big electricity bill at the end of the month certainly will put more money in your pocket. So it's just a win-win situation. So yes, partnership, but the banks must actively advertise their willingness to onboard those risks.
Thank you very much, Naomi. Next question. Interesting point, refunding gap based on insured value, based on cost of construction. How do we manage or make it affordable to pay replacement cost insurance when salaries remain stagnant? That's a challenging one for Graham here.
Well, I actually was going to toss it back to you, Tracy. I think that's a better place for the central bank to to be able to answer on salaries and cost of living. Yeah, I mean it's a tough one, right? We have inflationary pressure outstripping our increase in salaries. So I mean, unfortunately, I cannot answer that one. I mean, the most we can do from the industry standpoint is do our best to control the price of insurance by controlling the type of product that we offer, but we will be limited to offering the product sort of a lesser coverage to the client to be able to control the cost. But if we have to offer the same product, under the circumstances with inflation, it will cost more. And if our salary levels are not going up as fast as inflation, because remember in the Caribbean, much of our inflation is imported inflation. So it's because we import so much, we import the inflation. We may not be able to control the rate of inflation, and that outstrips or increases in salary. So it's a great question that we all have to deal with. But I think it's such a broader macroeconomic issue that it's not just the cost of insurance that has to respond to that. It's the cost of food, it's the cost of gas, it's the cost of everything else that's going up faster than our cost of salaries can sustain. And it's a wider, I think, economic question that we have to answer.
Thank you very much. Our next question goes to Naomi Deali. What incentives are being given to vehicle dealers to import electric or hybrid vehicles for sale to domestic markets? And given the increased presence of the Republic Group in the Eastern Caribbean Currency Union, is any consideration being given to moving towards these types of vehicles?
Indeed, great question. I have been asking vehicle dealers in Grenada what the plan is for the next 5 years. I've seen recently Hyundai advertising their first hydrogen fuel vehicle, and they're interesting development world over with the EVs. It's why we are not importing them. Many of them talk about availability under their brand. Probably we need to step out of the box and go get new brands so that we could start leveraging the opportunities for modernizing the transport system. It's something we are looking at, and certainly once we see availability improves, because right now the supply chain issue is a real problem for vehicle dealers. But once we see that opportunity comes on shore, then definitely a loan product with a lower interest rate to encourage persons to cash in their diesel or gasoline vehicles for EV, it's something that the Republic Group will gladly embrace. I've said to my management team, it is part of our strategic plan that in the next 4 to 5 years, I wish it's sooner, its availability again, that our entire management team will be onboarding EV vehicles instead of gasoline-driven vehicles. A few weeks ago, government reached out because we do have some partnerships with the Department of Government dealing with the National Determined Contributions, looking at a partnership with our Green Climate Fund accreditation, which we're in the process of doing. And they are looking at a very interesting and exciting opportunity to transform Grenada's transportation system going electric. And that will be a link to loan, a combination of loan and grants. And that is an opportunity that the Republic Group would gladly embrace. And so it's a process, and we're working towards that goal. And it is my hope that certainly within the next 5 years, we will see achievement of success in that regard.
Thank you very much, Naomi. We have a sixth question. We'll take that question, and I think we'll wrap up because we'll have maybe a 1 minute from each presenter because we're due to end at 10:35. So this question goes, relatedly, there is the need to mobilize capital by encouraging greater participation by retail investors. What strategies will the financial institutions pursue to promote retail investing, especially in the ESG space? And that, I think, goes to Naomi again. So, Naomi?
We have already launched, thanks for the question, we have already launched part of our mortgage campaign in 2022, renewable energy systems for consumers, for residential as well as commercial. The opportunity to do that was linked as well to a climate smart checklist that we introduced. And that checklist is to, at the very early stage of the interview process, to sensitize the customer to the opportunity to onboard the greening of their project, the lighting you use, the way you probably look at rainwater coming off your roof and storing it instead of letting it go down into the drains. Put in a solar panel system, solar system on your roofs. And once that client decides to spend, it costs a little extra money, spend that money. When we do the progress reports and we visit the project and they onboard all those ideas at the end of the construction process, and as we finalize the bridging loan, that person automatically could qualify for a lower interest rate for the life of the loan. Those incentives are there for the taking. Unfortunately, I see a very, very low uptake in our market, but I hope it's the first year hope that's going forward, that persons will really capitalize on those opportunities. So the incentives are there, and we need to have the willingness to go that route, the willingness to embrace sustainability as an eco-friendly construction design as we go forward as countries. Thank you.
Thank you very much, Naomi. Thank you for that response. I think information to the public is really very important. And related to that is the question that was asked about the incentives. I think many of our countries have in place incentives for the duty-free incentives for the importation of hybrid and electric vehicles. And again, our governments must try to make that information available so people are aware of the incentives that are available. I now give each of our presenters 1 minute to wrap up before we close this session. We will start with Shari, who is here with us in studio.
Thank you, Chief Director. In closing, what I would say is that climate change is real and the risk associated with it is real. So integrating the assessment of climate risk in our risk management framework is very important, and it will ensure that our financial system remains sound and stable. Thank you.
Thank you, Shari. And let's hear from Randy at this time, please.
Yeah, thank you, PC. So yeah, I mean, it's again my pleasure to be a part of the conversation today, and thanks so much for the invitation. I think that we have real issues in the Caribbean, whether people want to admit it or not. In other places, that climate change is impacting us directly. They may not be feeling it, but we definitely feel it in the Caribbean based on the belt that we are living in. And if we are going to have to be exposed to bigger, stronger hurricanes that can completely disrupt our lives in the Caribbean, we need to be properly protected and we need to be properly assisted. And I think that's going to be the continuing conversation at COP and other places, that this is real for us for life in the Caribbean, and we have to find ways to respond. So we will continue the conversation in every circle that will listen, that climate change is impacting us in the Caribbean.
Ms. Diali?
Thank you, Tracy. Just to really implore all of us involved in the activity of banking, financial services, that this is a game changer. We have an opportunity to be part of a new financial ecosystem that is centered around sustainability, protecting the environment, and indirectly protecting our balance sheet and society. And so we need to play our part. We need to be part of that partnership, that circular movement, as well as spreading that culture of sustainability right through our organization and spill it over into society. Only then can we really get serious about sustainability for the years to come to protect the next generation. Thank you.
Thank you, Naomi. And my task now is just to thank the presenters on behalf of the executive management, and in particular the RSDAD team who have been putting on this conference, to thank you for your interesting and informative presentations today, and we look forward to continuing dialogue with you on these matters. Thank you very much.
Thank you very much, Ms. Polius, for so ably conducting the first panel of discussants. We are now going to give our attention to the second panel, It's entitled Landscape of the Eastern Caribbean Currency Union Post-COVID-19. In order to introduce the panelists for this second panel, we'd like to first of all introduce the moderator. And like her predecessor, she has the dual responsibility of not only introducing the panelists, but she also will be moderating the session. This is in the form of Dr. Valda Frederica Henry. Valda Frederica Henry is the Deputy Governor of the Eastern Caribbean Central Bank. She's the VF Inc.'s former Chief Executive Officer and Principal Trainer. She formerly served as a Senior Investment Officer at the Eastern Caribbean Central Bank and played an instrumental role in the restructuring of the investment unit and the development of the investment management framework of the bank. She has lectured in, among other subjects, human resource management and accounting, and has extensive experience in organizational reviews, job analyses, and job descriptions, working with companies in the Caribbean, and served as the coordinator of the Administrative Reform Program of the Commonwealth of Dominica. She has served as a mentor for executive and middle managers in many sectors, including banking, hospitality, and utility. Valda is also a global human resources and organizational development expert who excels at collaboration with very strong interpersonal communications, leadership, and decision-making skills. She has developed and led numerous multi-year personal and professional development programs for youth in Dominica, as well as individuals and businesses throughout the Caribbean. She hosted a weekly radio and twice monthly television programs on which she discussed solutions to challenges faced by businesses in the region. She wrote a column, Business and Life, for the online newspaper Dominica News Online. Valda holds formal qualifications in financial analysis and planning, governance, and business management. She's a chartered financial analyst, holds a PhD in industrial relations and business, Masters of Business Administration, Bachelor's in Management, and Bachelor's in Law. She's a certified global professional in human resources, Society for Human Resource Management, senior certified professional, and an accredited director. She is also a certified ProNet trainer and a Myers-Briggs type indicator practitioner and a certified Train the Trainer for InfoDev and the Women Innovators Network in the Caribbean. It is my pleasure now to introduce to you Dr. Valda Frederica Henry. She will, as I said before, be introducing the panelists and also moderating the session. Dr. Henry, you have our attention.
Thank you so much, Kevin, for the presentations that I missed this morning. Our next panel on the title being Landscape of the ECCU Post-COVID-19. And we all know the impact of COVID-19. But as we move forward, so yes, we've known it, but now, well, how are we going to move on? How are we going to thrive post-COVID-19? And to give us some insights, we have two panelists, Ms. Joanna Charles and Mr. Belfield Phoenix. I always have it upside down, but I'll get to it. And they're going to share with us some insights on how do we thrive and navigate COVID-19. You know, everything comes back to how do we transform our region going forward. So I will read the bio of the two panelists. Each panelist will have 20 minutes for their presentation, and then we will have a 30-minute discussion. So please have your pens, your paper, your computers, whatever it is you need, so you can take your notes, make your questions, make your comments, so that you can participate in the discussion segment. So Ms. Joanna Charles is the General Manager of Antigua Commercial Bank Limited, now trading as ECCB Caribbean, the second largest indigenous bank in the Caribbean, in our ECCU region. Charles has a wealth of experience, having last held the position of Deputy Managing Director at the Bank of St. Lucia. She also has extensive regional experience, having served on regional boards in the capacity of Director and Chairman of the Caribbean Credit Card Corporation and Director of Grace Kennedy Insurance. Charles is the immediate past chair of the Caribbean Association of Banks and also served on the ECCU Bankers Association as Vice President. Charles holds a Bachelor's of Science Honours degree in Banking and Financial Services from the University of Manchester and Masters of Business Administration in Finance from the Manchester Business School. This is my alma mater. She's also an associate of the Chartered Institute of Bankers, now known as the Institute of Financial Services, UK. Charles is an accredited director. Joanna Charles is a past president of the Rotary Club of St. Lucia 2017-2018 and enjoys hiking, interior decorating, and photography. Ladies and gentlemen, Joanna Charles will be our first panelist. Our second panelist, Mr. Phoenix Belfield, is an economist, entrepreneur, and credit union activist, recognized as one of the most prominent voices advocating for credit union growth and development, recognition, and financial inclusion. He is the general manager of the Dominica Cooperative Societies League Limited and the CEO and founder of M. L'Argent Wallet, a financially inclusive mobile wallet platform aimed at future-proofing the credit union movement by providing cutting-edge digital technological solutions for the movement and its members. Belfield also chairs the working group of OECS leagues and credit unions. Belfield is the host of the popular weekly radio and social media program, The Cooperative Voice, a program highlighting the contribution of the credit union movement to the national economic development and matters of interest to the membership. Ladies and gentlemen, I now invite Ms. Joanna Charles to make a presentation. Joanna, you have 20 minutes. At the 5 minutes button, I will give you a wave, so you know you have 5 more minutes. At 1 minute, I will give you this one sign that it's 1 more minute. And in 20 minutes, Joanna, you will be out. Joanna, my pleasure. So, Joanna, please unmute yourself so you can we can hear you fully.
Yes, my apologies. Can you hear me now?
Loud and clear.
All right, thank you very much. Thank you, DG, and thank you, Governor and the panelists before me for your very insightful presentations. Full disclosure though, since I moved to Antigua, I haven't done any hiking. I've been on a few walks, but I just find it too flat to do any kind of meaningful hiking. So hopefully I can resume that hobby sometime soon. All right, my presentation today will, the format for my presentation today will be looking at some topics. We'll be looking at the ECCU post-COVID, the global outlook, the forecast, the risk to the ECCB, challenges we are likely to be faced with, and the way forward. Okay. Crisis and opportunity. I think opportunity is always present in the midst of crises. The Chinese word for crisis carries 2 elements: 1, danger, and opportunity. No matter the difficulty of the circumstances, no matter how dangerous a situation, at the heart of every crisis lies a tremendous opportunity. Great blessings lie ahead for the one who knows the secret of finding opportunity within each crisis. Unknown. So I think that's the basis on which my presentation will be premised today. And we can proceed. Okay, post-COVID, there are a few developments which we're all very much aware of. To be honest, I don't think I'll be saying anything that the attendees don't already know, but I think it doesn't hurt to highlight it. There are a few things though. Post-COVID, I think we're recovering. However, the high commodity prices, and tighter global financing conditions are weighing on economic activity. However, we've seen some rebound at varying levels throughout the ECCU, and the governor alluded to that earlier in his presentation. That being said, though, the impact of the Ukraine war is a setback, leaving output in countries well below pre-pandemic levels. And while we've seen some stay-over arrivals, say in Antigua and Barbuda, for example, increased by 71% between January to December, achieving 88% of the corresponding pre-pandemic level, with arrivals from the US and the UK accounting for 50% and 31% of the total, respectively. In St. Lucia, on the other hand, the stayover expanded by 119% year on year. That's during January to August, but only reaching 81% of the 2019 pre-pandemic levels. But there were increases reflected in all the major markets. Okay, next slide. Of course, the topic of inflation is something that's very prevalent. It's driving up the cost of food, fuel, and transportation. However, the financial sector has remained broadly stable, and the governor also mentioned that earlier. But a lot of the banks accumulated high levels of liquidity. And if I may speak for the indigenous banks, especially those of us who acquired RBC, we accumulated a vast amount of cash. And it has been quite a challenge finding suitable investments for offloading the cash. In terms of the global outlook, again, the governor would have mentioned what is happening in his presentation. The future of our global economy is very dependent on the successful calibration of monetary policy, the cost of the war in Ukraine, and the possibility of further pandemic-related supply disruptions, for example, in China. As we know, a lot of goods are produced and manufactured in China, and getting them out of China has been a challenge. And we've also seen the increase in the supply chain issues, transportation costs, and so on. Global growth is expected decline, decelerate from a growth of 6% in 2021 to projected 3.2% in 2022 and 2.7% in 2023. The forecast for 23 is the weakest since the 2.5% growth rate seen during the global slowdown of 2001. And with the expectation of the global financial crisis and the initial COVID-19 years. So things are projected to slow down. As we can see on the graph, the advanced economies, I think these would include the US, the UK, the Eurozone. We've seen the projected decline. And the emerging markets, the decline is expected at a slower rate than the advanced economies. There is risk of a global recession, as has been predicted by the World Bank in a study dated September 2022. And as central banks around the world hike the interest rates in response to the surging levels of inflation. According to a study, though, it was concluded that unless supply disruptions and labor market pressures subside, interest rate increases could leave the global core inflation rate, excluding energy, at about 5% in 2023, nearly double the 5-year pre-pandemic average. So we are heading for some difficult times ahead. Okay, what does all that mean to the ECCU? Okay, there are some downside risks to the outlook, and we are predicted to be significant. We're already feeling them. Further commodity price shocks may dampen domestic demand and drive inflation higher. If the global recession materializes, this would significantly curtail the post-pandemic recovery of the ECCU. Fiscal deficits are projected by the IMF to remain sizable, leaving gross financing needs and public debt at elevated levels in the near term. A slowdown in growth in key tourism source markets could stall the tourism recovery. We've seen strong rebound in that sector, and I think the islands of the ECCU have benefited significantly from that rebound, with most of the hotels having a record occupancy in excess of 70% on a continuous basis, month after month. Okay, in terms of the recovery is expected to remain gradual and even, as I said earlier, the IMF projects that real GDP to grow by 7.5% in 2022, but that is expected to come down to over 5.5% for the year. And again, rising inflationary pressures underpin a cautious outlook for recovery. Okay, as monetary policy gets tighter in the advanced economies, we will start to see the impact on the ECCU, tourism. People may not travel as much as they did post-COVID when the market started to reopen. And further disruptions to our supply chain and associated higher shipping costs and raw material will also cause delays in construction activities. And the presenter who spoke about insurance, we will all, indicated that there will be increased costs of insurance. People who already have their homes or anybody undertaking new projects, these are expected to be impacted by the increased cost of insurance. Challenges. Currently, we're faced with significantly high NPLs above the 5% benchmark. Although I think there have been some significant improvements in some of the banks within the sector. And the high NPLs impact not only the banks, but the credit unions as well. And I'm sure any other financial institution that's involved in lending. Most of us would have been significantly impacted by the interest rate hikes in our investment portfolios that were in the advanced markets. We've seen significant unrealized losses from having those the investments in these markets, and profits and capital would also be impacted. Again, supply chain, as mentioned before, would increase the cost of construction. Currently, a lot of applications we see are for loans where the debt service ratio is already probably at 50% of the net disposable income. And with increasing cost of insurance, I guess we banks would have to, come up with a strategy on how we, protect customers from probably deploying, most of their income into, paying off their mortgage loans. So these are some of the things I think we need to come together to come up with a plan of how we can protect customers, but also protect ourselves as banks. What we've been seeing is the difficulty in trying to match supply of labor with the availability of jobs. A lot of the young people, they're just not interested in working in a bank. And we've had challenges, especially here in Antigua, in filling some of our key positions. And, even where we want to do some data cleanup, scanning documents, as we move towards greater automation and so on, it's difficult to find temps. And I'm saying, but that is just crazy. But this is what we faced with, where a lot of young people now have the opportunity to create their own businesses, work for themselves, as easily and enabled through technology. And they created their business in such a way that they fully utilize technology, both on the supply side and on the payment for the goods and services that they provide. Earlier, we spoke about climate change and the impact that it has had. Last Sunday, for 2 hours, we had I'd call it a freak storm that significantly impacted St. Lucia and Dominica. And a lot of these, as we've been told, as a result of climate change, global warming. Again, as Naomi would have, taken us through a very good presentation on what's in store for banks and how we can respond effectively. So I'll not go into that in any great detail. Again, another challenge is the cost of borrowing for governments is increasing. High debt to GDP. In the pre-COVID years, we saw that most of the governments were kind of, manage their debt to GDP downwards. And but since 2020, we've seen a spike, and in most instances, expected to be high in 2022, but there's still some uncertainty, although the projections have gone down, but there's still some uncertainty in 2023. And again, these are just projections. Okay, the way forward and opportunities. I think in every crisis, there's opportunities. You just have to be ready to be able to take advantage of those. And what are those opportunities? I think a lot of customers will be looking towards the banks for wealth creation, moving away from savings. All those savings that they've, funds that they've accumulated and saved during COVID, I think they not only want to spend them, but I think they want to use that money to invest and create wealth. So I think we have to be in a position to be able to do so. I think as air travel, the issues with air travel, as they're resolved, hopefully it will become more affordable. Probably the decision to host the conference virtually maybe had to do air travel. I don't know, I was kind of looking forward to meeting everybody, but I understand that probably to get to St. Kitts, it would probably go a Saturday and come back another Saturday. And that's some of the challenges that we face. So there has to be some resolution, whether the banks can get involved. This is something that we need to explore. Again, addressing climate change and building resilience is crucial. And developing products. And while gentleman from the insurance sector was presenting, had some thoughts on probably how the banks can respond to the insurance cost for customers, and it's something that we can probably discuss at the Bankers Association level. Okay, I think there has to be a greater push towards digitization to improve the speed and quality of services offered. Technology is not cheap. And I think if we can come together to be able to negotiate, come together, especially at the ECCB Bankers Association level, to negotiate prices from our vendors, I think that will serve us well now and in the future, because I think a lot of times they play divide and rule, and we tend not to speak to each other. I think there's opportunity there. So that's one way of reducing the costs associated with technology. I also think, and I don't have it down there, that if we can develop a technology strategy, because at the end of the day, most of us have the same core banking system, the same alchemy, the same software that we use. But I think it's time that we come together and to be able to decide what we want our technology framework to be. And because we all have the same cyber security risk, all of them are the same, nothing different. So we have to leverage, the Bankers Association to be able to enable that. I know governments will be looking for soft funding to undertake projects that could stimulate economic growth and recovery, especially those countries who still have issues with the infrastructure and so on. So I think we have to be in a position to be prepared to assist, and also additional avenues through the ECCU, the stock market, to provide more avenues for customers to raise capital. I still think it's still underdeveloped. When you look at Jamaica and the progress they've made, I did a presentation at CAB recently, and at the last ECCB meeting, that there's a lot that is taking place and happening currently. And I'm hoping that, some changes are going to be made at least to the requirements for listing on the stock exchange, especially for those companies in a more type of junior market scenario. And I think that's critical. Just moving a little faster. Yes, I think providing financing for major corporate projects that were on hold during COVID, we've seen quite a few requests to those companies who come back and say, you know what, yes, I think I'm ready to move now. And I think kind of give them time to reevaluate, reflect on the way forward for them, take stock of their own operations, make changes where necessary. And I think that kind of worked well for us. So we've seen a lot more companies more updated with their audits. It's something that we've been grappling with for a long time. So I think there are positives in every crisis. Syndications, they're quite a beast. I've seen a significant increase, and I think there will be more as we work towards spreading the risk among ourselves. I think this will also bode well for us. I also think there'll be exponential growth in consumer spending, and we are going to see an increase in our credit card portfolios. I also think that improved performance in the tourism sector we're going to see some spin-off of some tourism-related SME businesses. And I think we need to be able to identify those opportunities and also, make greater use of the ECPCG, the guarantee fund, but also understand intellectual property and how we can finance those businesses that are in that sector. And earlier I mentioned leveraging the ECCU Bankers Association to negotiate better pricing. And I think that is key, not just for technology, but for other projects that we can do jointly and share the costs to have, just to create greater efficiency. And again, I think recession is an opportunity in wool's clothing. I think we just have to not sit back, but identify the opportunities and be ready to take advantage of them. And I've come to the end, and thank you very much for your time and attention.
Thank you so much, Johanna. This was succinct. You were on 19 minutes, well timed, so I didn't even have to come back with my 1 minute. Excellent. Excellent presentation. There are some points that I would want to raise, but I will do that later in the discussion segment. I now hand over to Phoenix Belfield, who is going to present to us on the very same topic, the landscape post-COVID-19.
Thank you very much, Deputy Governor. Just testing that my audio is well received.
I can hear you loud and clear.
Okay, let me just share my screen. All right. Okay. Is my screen properly shared?
Yes, it is.
Okay, wonderful. Well, thank you very much for the privilege of speaking with you this morning. And it is often a privilege for us, the credit union sector, but part of a large and responsible gathering of financial institutions to actually be in a forum such as this. And it is really kudos to the leadership provided at the level of the ECCB. I remember the first time we were invited to speak at what was then the Bankers Conference. I think that would have been the last of the Bankers Conference. And it has since evolved in a truly inclusive way and manner into the Conference for Licensed Financial Institutions. So this morning, in the few minutes that have been allotted by the chair, I would like to share with you in the context of the ECCU credit union sector on the opportunities, risk, and challenges on the way forward. When we speak of the credit union sector, we oftentimes have to look at from the context of why the credit union matters. And we often find ourselves having to explain our raison d'etre, or the reason why we exist, and to reiterate the purpose for which we were created. So I use this analogy of the cow and the egret to really emphasize the symbiotic relationship with the credit unions and the regulators, banks, governments, and private sector. And really what it tells us is that, listen, we can all have benefits from the commercial space without having risk to each other. And like the egret and the cow, it's something that has always fascinated me. How can the cow stand these birds picking around them and getting into their way? But they're actually serving a critical purpose. And this really leads us to understanding the purpose of the credit union sector, because before you can understand our plight, understand the situations that we're faced and how we are making during the sector, I think we need to understand why we came into being. And like the egret, we serve a critical segment of the population that is underserved. You would have heard from the governor about the access to accounts and how difficult it is in some jurisdictions for the average person, the mom and pop shop, to have a business account at a financial institution, or the average man on the street to open an account at a financial institution. And that is where we came in over 60-something plus years ago, to serve that underserved population, and particularly those young persons that are being served. We have, if you look and you really want to understand the context of credit union and why we matter, you do not need to look any further than, for example, in St. Patrick. You can look at the St. Patrick Credit Union in Montserrat. You can look at Liberty Credit Union and what they're doing in Anguilla, very small credit union. You can also look at Hermitage Credit Union in Grenada, or you can even look at St. Mary's Credit Union in Dominica. And you can understand the critical role that our small credit unions are playing to provide financial inclusion and access to the underserved. So really and truly, in understanding the symbiotic relationship between us and the regulators, it is a matter of coexistence. And we believe, like I would tell my colleagues in the banking sector, we compete, but we complement. And together we have this higher calling or responsibility to improve financial access and access within the sector, and grow the space within the confines of regulations and so forth. So I just wanted to preface that discussion so that the people who are here can understand the reason for which the credit unions were created and why we continue to evolve as a sector. Now, in terms of the EC jurisdiction, we have an asset size, and this is in terms of US billion, 1.725 billion across the 8 jurisdictions. We have membership in terms of membership accounts, 413,000 membership accounts. We have savings totaling 1.4 billion US dollars and loans of 1.17 billion. So, and these are not commercial loans. These are loans in the retail sector. These are loans of the average guy on the street that wants to open an account and wants to fund his education or wants to provide health care for his family. These are the small agriculture farmers, those persons in the small SMEs, those in the services sector, that we continue to provide hope and help them to achieve their dream by providing financial access. I was actually recently asked by an international organization as to why is it that the credit unions are growing in terms of importance and their value proposition to the membership increasing. And I'm saying simply because we find a way to reach our membership at a point of greater need. And that is why, even in spite of the fact that we've seen consolidations in the sector, the people are still understanding the credit union ethos, and they are going to the credit union to provide that level of financing. Of course, for the commercial side, our commercial partners, the banks, provide already commercial loans in that area. But in terms of the credit union sector, some of the opportunities that present itself within the EC jurisdiction, and one of the things that we've learned even here in Dominica and also within the OECS space is how the credit unions have typically been the first responders in a time of a pandemic. And we're actually playing a critical role in driving the recovery process of the financial sector. Now, some of the areas that are going to be open up for us, and my fellow panelists mentioned about it, about not letting a disaster go to waste. We have seen from the advent of Hurricane Maria and Dominica's push to become the world's first climate resilient country, and our focus on green technology and investment and innovation and digitalization of the economy, we're seeing increasing opportunity in green investment. And it is now for us as a sector to really look into it. We're working collaboratively with our strategic partners, the OECS, the ECCB, to see how is it that we can have a more robust green investment portfolio, because we have the things free at our cost. We have brilliant sunlight. Let be the impact or the footprint of solar panel usage in the Caribbean and within the sub-region OECS spaces is very limited. There's also the instance of digital adoption. How do we increase our digital footprint as credit union? In fact, it is proven that it is 10 times cheaper in branch services to members as against mobile services. And so how we adopt the digital technology, how do we digitalize our processes, how do we provide online access for our membership is going to be critically important as we drive our strategic vision going forward. Again, I mentioned earlier about the SME sector, a critical, small but critical ingredient, because we believe that the private sector is the engine of growth and development of the economy. And the small businesses of today will become the large businesses of tomorrow. So for us, it is important how we continue to engage that SME sector. And that is why over the next couple of months, we have seen our credit unions have been focusing on providing training to the small business entrepreneurs, finding out from them how is it that we can serve them better. And we're now working on a different suite of products to be able to provide them greater levels of services, financial services. Again, this ties into the access to financial services at the credit union level. And I could not have said it any better than the governor said. And I can sense the passion with which he spoke, because this is an important facet of our life within the OECS space. And that is why the credit unions continue to be a major financial inclusion partner for the governments, for the private sector, for the mainstream financial institution, to plug that gap, that critical gap, in ensuring that all our citizens have access to financial services. And there are the two other areas that were mentioned earlier, the access to partial credit guarantee scheme, which is really of importance to us, because we have a unique situation. For example, our Kalinago brothers have lands that they do not own. And this is by legislation. Now, they cannot use those as collateral to be able to access loan at the financial institution. So how can we help that? And this is an area where, and that is why we've been lobbying along with the CCC or Caribbean Confederation of Credit Union, and we've been speaking to the ECCB and the ECPCGC as to how credit unions, not only banks, how credit unions can have access to that, because we are the financial institutions that are where the members need the most. And we need to be able, if you exclude us from this critical mechanism, you're excluding a large segment of the population. So I was really heartfelt and I really feel very warm that the overtures of the ECPCGC that we continue to engage, and we are hopeful that by the next session that we can have access, and you can report that the credit unions are also part of this. And then the other section related to the credit bureau services. We're seeing how in an effort to manage the risk on the credit union side, how important it is to have a credit scoring mechanism, because right now, how it is done, we have to, if a member needs to get an account, they have to walk around with a couple of sheets of paper, and they have to go around physically to each other credit union or bank or other MSBs to get credit reports, and then to bring it back to the credit union. How a significant savings that will be when the credit unions will have access to the credit bureau services, where we can simply look up the credit score and be able to expedite the access to financing for those members. In terms of the risk, we face pretty much some of the same risks that are faced by the mainstream financial institution. We have the instance of the regulatory environment, or we look at capitalization, forbearance, and the different regulatory pressures. And we have been at pains to explain to our membership why is it that the regulatory environment is changing and evolving over time? Because they have come to know the credit union as their village bank, as their social bank, as we say, or the poor man's bank. And all of a sudden, the credit unions are now asking them for the name of their we say Pawe and Nene, their godfather, the name of their pet, and all of that. And these are some of the regulatory pressures that all financial institutions are now having to grapple with. We also face the instance of increasing liquidity risk. How can credit union improve its funding sources so that it can avoid runs on the financial institutions? So this is something that we've been even talking at the level of the movement as to how we can use the liquidity of the larger credit unions to offset some of the liquidity concerns of the smaller credit unions. We've been looking at, and this is very, very area of great passion for us, debanking. And note I said debanking and not de-risking, because we have instances within the sub-region where mainstream financial institutions are not recognizing the critical role that these small credit unions, like those in Anguilla and Montserrat, play in terms of bridging that divide for financial inclusion. We would like to call on the financial institutions and the banks to play a greater role in bridging that divide and working alongside the credit union, just like how the birds work with the cows. We can find synergy if these financial institutions can find ways to work with the credit unions, because the role that these credit unions play in these institutions and all areas of the OECS, really it's critically important. So we need to place a serious emphasis on the risk of debanking, and this is not debanking by corresponding banking relationship. This is debanking by mainstream financial institutions in the OECS space. So we need to ensure that we consolidate that interaction between the credit union and banks, and we ensure that we work together in harmony to ensure that we not only provide and amplify access to financing, but we protect the space that we have. In terms of credit and interest rate, that was spoken about earlier, so I will not get much into it, but we too, just like other financial institutions, we run the same risk to our balance sheet. Strategic and reputational risk, in some cases, the credit unions are perceived to have lacked the responsiveness to the changes in the industry, and our presence on social media have not been so prominent. And in fact, now credit unions are having to raise profiles on TikTok and Twitter to be able to readily engage with this growing population of this growing youthful and very important population. In terms of some of the challenges that we face as a sector, access to liquidity support is one of them, but we so far, and I think that is that is testament to the resilience of the movement, testament to resilience of the governance and the regulation of the sector. No credit union has really had to seek outside of the confines of its movement and economic space liquidity support. We continue to be concerned about the access to correspondent banking relationship. We welcome the introduction of newer banks. We also look with a level of concern, strategic risk and concern of the consolidation of the sector. Of course, there are benefits to be had from the consolidation. We also need to watch at what the consolidation brings in terms of strategic risk to the sector, and even more so to the credit unions. We need to put a specific focus on that area. We also look at the regulatory burden that are increasing. We have an excellent relationship with our regulators, and we're also urging all the other movements and credit unions to also have a similar relationship with the regulators to see how is it that in the matters of forbearance and easing of regulatory pressures that we can work together to protect the sector, but not to make it unnecessarily burdensome for our members and our members, that is in terms of credit unions, to be able to comply with those regulatory pressures. Challenges again, economies of scale. In terms of operational cost, how do we scale our operations? We're looking at more leaner credit union operations, and you can see over the last couple of years, whereas financial institutions have pulled out of certain areas in our jurisdictions, the credit unions have actually been expanding into these underserved areas, and that is why it gives me so much passion when I speak about credit unionism and credit union movement, because whereas we go into the areas that in some cases mainstream financial institutions do not deem to be economically viable areas, and we provide that, we absorb the cost because we want to provide that critical support and financial access that is needed for our membership. Access to affordable technology, my predecessor spoke about that, my fellow panelists spoke about that. We too have the same access. For example, here in Dominica, only one credit union offers international debit card of the 6 credit unions. And you can see that across the region. So our level of digitalization footprint is significantly lower than our competitors and collaborators within the sector. And this is, again, an area that we're looking to see how is it that we can improve on. Board leadership and engagement, the aspects of governance is also a critical factor for us. And we continue to place specific emphasis in this area as to how do we improve governance within our sector, because it is not only about the market, but it's also about the leadership. And then finally, in terms of the challenges, is the perceived lack of relevance and visibility. We have had to, like I explained earlier in the equation about the egret and the call, we have had year and time after time to have to explain why we are here and the purpose for which we serve. And this is something that we have to grapple with. The leagues have to grapple with. The credit unions have to grapple with. We have to rid ourselves of that notion of a parasitic financial institution and really be seen as a critical player by governments, by banks, by MSBs, by other financial institutions, because we serve a critical mass of the population. And so with those challenges, we have not given up on the resolve, and we believe that the reality that is being faced with the credit union is pretty much different from the reality that was 60 plus years ago. And we believe that the future of the credit union will depend on how we adopt different technologies, different loan practices, how we look at the existential threat from rising competition. Credit unions generally can compete with mainstream financial institutions in terms of interest rates. So we need to look at how we can change our levels of service offerings to remain relevant and to remain competitive. And so our focus must now move towards investing in innovation and using that as a key deliverable to driving our strategic ambition. And so for us, as a way forward, what we call a 4C, not to be confused with the company in St. Kitts. We call it 4Cs: cooperation, coordination, capacity, and capability. In cooperation, we must collaborate. And not only credit union with credit union, leagues with leagues, but also credit union with financial institutions. Like, for example, we have started discussion with some of our financial institutions as to how we can collaborate in the area of compliance, because compliance is everybody's business. So how can we collaborate in that area? Coordination, how can we have sensible regulation in the sector? And I oftentimes, and most of you would have heard me before, I often make the case about a truck and a car, how we do not regulate based on the fact that we all have four wheels, but we regulate based on the purpose for which each of these vehicles serve. So we continue to advocate for sensible regulations. We look at capacity. How can we build local talents and leadership within the sector? My predecessor spoke about attracting talents and how the talent market, the labor market is shifting at an alarming rate. And then we look at capability. How can we enhance cross-border cooperation and interoperability? So these are the four areas that we think are going to be critical ingredients or critical areas of focus for us to focus as we look at the.
And so we had two, profound presentations. And if you look at it, there's some similarities in terms of the challenges. There's some similarities in terms of the way forward and in terms of the focus. I have my own questions and comments, but I'm going to open up the floor first to the participants, if there are any questions, any comments for the presenters, and then I will give my views. Do we have any questions? Okay, good. Great. There's the first question. Oopsie daisy. Okay. With the looming recession in the U.S., which is predicted to be mild or moderate, consumers and customers will be preparing for a possible recession. How can we stay resilient with uncertainties? So the question is, with looming recession, how can we stay resilient with uncertainties? And I would address that to both of you, but Joanna, take the first take at it, and then we will pass on to Phoenix.
Okay, thank you, Governor. Thanks for the question. I think the COVID pandemic taught us a lot of things. It taught us to be resilient, it taught us to be flexible, and we saw a lot of cooperation, both from the regulator in terms of being flexible with amending regulations as necessary. So I think a number of players would have to come together to be able to resolve that issue. It may mean that we may have to reintroduce the moratoria, the whole moratorium initiative that we had during COVID. And I must say, though, most of the customers who had taken the moratorium have resumed to paying back their loans, and we saw very little fallout from that. So I think these are some of the things. I think we already have a framework in place, because I think one pandemic is no different from another pandemic or epidemic. And I think COVID was a good test run for us in that sense. So I think, yes, we have to discuss it and probably come up with other initiatives that we didn't consider not appropriate or relevant to COVID. But there is, I think, a template that we can use if that were to happen.
Thank you very much. And Phoenix, please, your take on this question.
Very, very good question. Very good question. What we've seen in the sector is credit unions have positioned itself as being recession-proof. And this is premised on a couple of factors. One, the collaborative nature of how we do our business, the fact that we are heavily entrenched in the village and the communities that we serve. So there's a greater sense of, if I may say, patriotism on the part of the credit union sectors and the members. And so we see that as part of how do we help. It is not about what the credit union can do for you, but how the membership can also help the credit union to help themselves. So we look at that. Ms. Charles spoke about forbearance. This is critical. And we must, I know our regulators have come in for flat. We must also give them some flowers. Over the last couple of years, particularly in the case of Hurricane Maria in Dominica, and also in the advent of COVID, we have seen how our regulators both from the banking sector and the credit union sector, they've come to the fore and they've shown us how they can use the letter of the law and the rules responsibility under their care to assist the sector in assisting the recovery process. So we must give them kudos for that in that department. The other way in which we can also retain our level of resilience and how we can develop a sort of recession-proof model is by how we become flexible and innovative. So Charles mentioned it earlier, we cannot let a disaster go to waste. And every disaster that strikes, we need to ask ourselves a critical question. What lessons can be learned from it? So Hurricane Maria taught us about building back better, building back resilient infrastructure. So the insurance company learned a critical lesson about, reinsurance, the importance of reinsurance. The banking sector learned a critical lesson in terms of having evaluators of those properties, have them doing constant evaluation every 3 or periodic evaluations. So every time there's a disaster, we need to ask ourselves what lesson. In the case of COVID, we learned that, hey, if we're going to spend 2 years without having in contact, do we have an alternative mechanism by which the members can use? So that is how we start to improve our digital and technology channels. So this is all part of it, how we can develop a recession-proof model for credit unions and for the banking sector by ensuring that there's constant communication with the regulators, by ensuring that we keep our ears to the ground with our membership, by adopting digital and technological advancement and practices within the sector, and by being open to innovation and adoption.
Thank you so much, both of you, for these answers. There is a comment. The free movement of persons is a key pillar of the CSME and is necessary for the region to leverage our collective expertise to achieve sustainable growth. And I think that comment, it confirms or it supports the arguments that both of you have made in terms of the need of collaborations, coordination, greater synergies, and as you said it, the symbiotic relationship, strengthening and deepening that. And I really love the symbolic example that you use with the core and the egret. We got it. And there is a question or comment now for Joanna. Charles, the great point about the inefficient labor markets. There are large pockets of unemployment among graduates as well as mature professionals in some member states and scarcity in others. The problem of inefficient labor markets in the community is often ignored but must be addressed. And so that comment was specifically sent to you, Joanna, for your comment. Joanna, you need to unmute because we're not hearing you.
Oh, I seem to be doing that a lot. But anyway, I say yes, in some markets, I agree that there would be some excesses. Like in St. Lucia, there seems to be an excess in certain areas. And maybe in a country like Antigua, where the population is smaller, you'd probably have some challenges. While that may be so, I think when jobs are advertised, I think, as if anything else, there's a process. You look inward, you look in-house first, then you go to your market, and then you put it out there to attract the best candidate for the job. And I think to a certain extent, to a large extent, I would say all the banks are doing it. The challenge some of us may have is probably, you have higher cost of living in some islands than you have in others. And sometimes the pay that, for that job may not necessarily be attractive enough to be able to accommodate some of the costs that would be incurred. For example, here in Antigua, Anguilla, and some of the other northern Leeward Islands, the cost of accommodation is a lot higher than a market like St. Lucia. So, we are aware of the challenges, and as much as possible, we do go out to the market to attract the best candidates if it's not, if it becomes difficult to get somebody internally or even within the market that you operate. So so these are things we do take into consideration.
Thank you for that. Okay, there's a second question, and will be addressed to both of you. Have we made any inroads to capitalize on shared services to help reduce the cost of financial services to the customer? So I'll just repeat that. Have we made any inroads to capitalize on shared services to help reduce the cost of financial services to the customer? In essence, any collaboration to share costs?
Yeah, okay, I can go. Recently, we were working on a shared service project for risk and compliance. And we hired a consultant to undertake the project, do the analysis, provide some recommendations and so on. But what we found was that what was proposed did not necessarily result in a cost reduction or efficiency or anything that was different to what we already did. So we had them to go back to the drawing board. Now, the thing about that is that there are other components of it that are necessary to make it work. It's not just the banks doing it, but there's a role for the various governments. Now, a lot of the banks have adopted the whole DigiGov concept now that, I was so pleased when I saw an email telling me that my driver's license expired and that's in St. Lucia and that I can, initiate the process of getting renewed online. I was really pleased when I saw that. And I'm saying, how can we use that same technology to give banks access to the government's network to get updates on things like driver's licenses, because that's the best place to go to get that, and in real time. And some of the islands are a lot more advanced than others. But I think that's one area that would greatly assist in achieving at least that objective of becoming more efficient, especially on the account opening side that the governor spoke to earlier, and asking customers for 2 pieces of ID or 1 piece of ID or not having ID. I think almost every citizen has some form of ID that the government has issued. And if you can get access to that, there's no need for us to constantly, upload those documents as a customers to bring it. So if you can get access to it, I think that's one. So I think there's a lot of collaboration that's necessary in that regard. There are some other projects, and I alluded to earlier, that now that the ECCU Bankers Association now have a strategic plan, and I think that is a key priority, strategic priority in the strategic plan, that we work together on developing those shared service projects that we can all benefit from. So I think, yes, that's something that if we didn't pay too much attention to it before, I think going forward, we've recognized that we don't have much of a choice to do so.
Thank you, Joanna. Phoenix, your input on this question, please.
Yes, absolutely. I totally agree. If I could holistically endorse everything that Joanna has said, I think that she made a very excellent point to that. Shared services is really part of the ethos of cooperating among cooperatives. And that is why, for example, I'll give you an example of how shared services have helped us in the sector, even here in Dominica, and also you can see examples in St. Lucia and the other cases, where, for example, we have one credit union with a BIN or debit card, international debit card. However, that credit union uses shared services to provide a card, which is local card, for two other credit unions. So they don't have international debit card, but they have their own branded card, which their membership can use at any one of the branded ATMs around Ireland to remove money. So instead of having to now invest themselves in a critical infrastructure that the larger credit union already has, it can now use shared services as a means to leverage those services increase viability and visibility, and still reduce costs. So for us, there is no way to go, as like you said, individually we can walk, collectively we can run. So if you're not collaborating, then you are clearly defining for yourself. I remember the governor said in a presentation, he says, if the forces for change on the outside is greater than the forces of change on the inside, then the end is near. And for us, surviving, we cannot survive as an island. So shared services and collaboration has to be part and parcel of how we do business.
Chair, if I can go back though, just
Yes, please.
add that 4Cs is one of the, I think one of the most successful shared services projects that we've undertaken jointly, where back in the day we were not big enough to apply for principal membership from Visa and MasterCard. And we came together to form that company, capitalize it, and 4Cs is now the processor, our credit card processor in the region. So I think it, that is a very good example of a shared service. Yes, we have some challenges, but I think if we can continue with that model, of course, you have to improve it as time changes. I think it's something that we can always go back to as probably a blueprint for some of the areas that we want to explore.
Thank you very much, both of you. There is a third question. I note concerns of the regulatory environment, but how strong is the governance arrangement in the credit unions in regards to oversight and accountability based on its structure? So in essence, is the concerns of the regulatory environment, but how strong is the governance arrangement in the credit unions in regards to oversight and accountability based on its structure? Phoenix, that's for you.
Thank you. This is actually, and I think I prefaced it in my presentation, this is actually the single largest concern that we have in the movement. We have benefited over the last 6 decades from talents who have come to the credit union voluntarily and offer their services. And whereas for the other financial institution they serve, they get a stipend or they get a salary. In the credit union movement, they don't get anything, it's for free. One of the concerns have been for us, and that is why we've been engaging the regulators and even engaging the credit unions at the level, is how can we strengthen the governance? And we do appreciate at this point in time that it is not where it should be. But we've not given up on it. We're working assiduously to ensure that we can enhance the governance. And a couple of things that we've been looking at is how can we increase capacity building in the sector to ensure that all our volunteers are trained, understand the basic rudimentary of analyzing financial information and duty of care and making critical decisions as it relates to the day-to-day running of the operations, understanding the demarcation line between board responsibility and management responsibility and supervisory and compliance committee responsibility. So these are the things that are really keeping us up at night. Other than the macroeconomic factors, governance and compliance remain the single biggest obstacle or the single biggest concern that we are attracting. And that is why we have, for example, we're collaborating with the Confederation of Credit Unions to see how we can have the governance training for the directors, management, and those people in governance at the credit union, so that we are hoping that by increasing capacity building, training, that we can enhance how we do business and how we govern the institution. So yes, I do concede that we can do better. We can do better, and we hold ourselves in high regard. And that is why we've taken concrete steps to improve. We're working with the regulators. We're working with our partners to see how we can improve. So yes, we must improve. We're not where we should be. We're not where we want to be. But one of the things we've also looked at is the model that we've adopted in terms of how we attract talents to the credit unions over the last 60 years. We have to take a critical step now and look and see whether that is going to be able to sustain us for the next 60 years. Now, we want to tweak and change a few things, but we have to be mindful to stick to the purpose for which we were created. So that is why it is something that is attracting the attention of the individual boards at the leagues level. It's attracting the attention of the regulator, and it is something that is even attracting the attention of the ECCB. And we're hoping, we've had great dialogues with the ECCB in terms of what the ECCB is looking to do with this harmonized credit union regulation, to see how is it that we can bridge that divide and enhance governance in the sector. So yes, we can do better and we will do better.
Thank you very much for this. In fact, governance is really critical, and you did stress on it even in your presentation in terms of one of the challenges for the credit union movement. And as I speak here, I'm in the Eastern Caribbean Stock Exchange. Joanna earlier spoke about the ECSC, and maybe there's a role for ECSC, say in wealth creation and going forward, and even a junior market. But the ECSC also has a very internationally recognized director accreditation program, and maybe you'd want to have some dialogue and collaboration and coordination with ECSC as part of strengthening that governance structure within the credit union movement. There is another question for you specifically, Mr. Battlefield. Would it not be easier for credit unions accessing liquidity support, a lender of last resort, capacity building, regulatory oversight, if they collectively assimilate under the banner of the Eastern Caribbean Central Bank? So in essence, what the person is asking you, would it not be for the credit unions best if it's assimilate under the banner of the Eastern Caribbean Central Bank?
And this is the example of a loaded question.
It's very loaded.
Very loaded. Listen, there are a lot of moving parts in this debate. We have never been adverse to being regulated at the regional level or at the national level. Our position has always been that sensible regulation should be attracting the attention of the sector. Now, whether it's under the ECCB, whether it's under the FSC, or whether it's under our local regulations, we have to have attendant responsibilities in that department. There are a couple of things that we also need to factor in. So it is not just about who regulates, but also how we are regulated. That becomes the critical conduit to how we arrive at which is best for the collective good of the industry. Now, we have made the case to the ECCB in consultations. We've made the case to our local regulators that the preservation of the historical importance of the credit union is of paramount importance. And if that can be best held or maintained under our local regulators, then we're prepared to work. If that is best held and maintained under a greater umbrella organization, then we are prepared to work. But one of the things we will continue to advocate for is to ensure that there's the preservation of the historical importance of the credit union, and the reason why we came into existence, and the unique purpose which we serve, which we have served and we continue to serve. So it is not necessarily for us to determine who is the better regulator. We, as a responsible financial player in the sector, we're prepared to work with whomever the governments and the powers that be designate as the official regulator for the sector. Our only concern is that we are regulated understanding of our purpose as egrets in the sector.
You sure you're not a cow? You're just focusing on this egret there, eh? Credit union will maybe one-time egrets, but now they may be cows. And so, yeah, because some of the credit unions are, in fact, bigger than some of our banks. We have to now begin to look at it even in a bigger sphere, that, yes, maintaining the purpose. But in the question of it, the growth and the expansion of the credit union, I think it calls for wider discussion in terms of not just who regulates us and how we are regulated, but even in terms of the growth. Going back to your question, how can we still best serve that purpose, recognizing the changes that have taken place? There's another question for all panelists. is it fair to say that the credit unions are now morphing into the community bank model and the ECCO banks morphing into the US-type big banks? If so, to what extent is there an urgent and important need for the ECCB to advance the regulation of the credit union sector? So that this question comes back in a different way. So that seems to be the theme here now. So are the credit unions morphing into community banks? Are they really banks now, rather than just credit unions? And are our banks now morphing into these big banks, given the consolidation in the banking sector? So if so, to what extent is there an urgent need for credit unions to be regulated by the ECCB?
Can I ask Joanna to go first on this one? And then
Okay,
I'll come back?
Joanna, they want you, please go first.
Okay, no problem. I think that's Brett King who said banking is necessary and banks are not. So I think the critical thing there is satisfying the need, and the need is for customers to have access to banking services. Now, to the extent that banks are morphing into U.S. banks, I don't see that. A lot of the services we provide are very basic in nature. If you look at the U.S. banking sector, they do not have a fixed minimum savings rate. We do. So their market is, different to ours. Yes, there might be some products that we've begun to offer, and what are they? Mutual funds that, we're still behind on that. We have Trinidad, Jamaica, and these are the islands way ahead. We're probably just getting into that sphere. I don't know, credit cards, our rates are quite competitive. I'm trying to think about the question. Maybe the person asking the question probably need to be a bit more explicit. But I think in terms of regulation, I think the regulation, is or moving towards, I would say, international standards. And there are a lot of international benchmarks, and justifiably so. I mean, when we look at cybersecurity, we all exposed to cybersecurity and the risk of not having proper risk mitigation framework in place. So yes, I have no issues with the regulator taking a position on setting some standards for IT. And there are whole other areas that and the thing is, whether you want to start to, delve into those other the international markets in terms of the products, or giving customers 24-hour access to products and services, we all face with the same risks, whether you want to or not. And customers are demanding a lot more from the local banks than we probably at a stage where we can provide. And there are things people are saying, but how come I cannot do that? And they don't compare you with First Caribbean or, say, another bank. They compare you with Bank of New York, and they say, I can do that with my account of Bank of New York. Why can't I do that? Why can't we have Zelle? Why can't we have this? Why can't we have that? So the demand is there, and we've been forced to play in a market that probably we are not structured to be able to play in that market as yet. So I think there's a lot of transition that's taken place, whether we want to or not. Whether the credit unions are having the same challenges. I'm just, kind of stepping over into your area as well, to say that, yes, customers are demanding things from you that you probably need to be in a position to be able to provide. So I think that's where we are. We all doing catch up at this stage. I think it's a global market. As we have seen what happens in the global environment, it impacts us. We've all in some way or the other been subjected to ransomware, some type of cyber fraud, and so on. So yes, maybe if that is how morphing into the international market, that's a description for it, then I'd say yes, it's happening. And the regulator, of course, needs to be able to catch up with what's happening. So whether it is cryptocurrency or whatever it is, I think whether we want to or not, we've been thrown into the deep end. The unfortunate thing is that we're probably not able to do so at a faster rate than probably, I was watching an interview with, somebody sent me last night with a young lady, and she said when she went to Holland 10 years ago, it was new for her because back then they had contactless. So you use your card in the metro, you use it everywhere you go is contactless, and we are only just now getting to contactless in the region. So yes, it's a challenge all around.
Phoenix?
Yes, I like the question, but for the wrong reason. This actually defines the road to relevance. Ms. Charles mentioned it earlier. We are playing catch up. The demands of our marketplace has significantly changed over the last 5 years. In fact, there have been a more astronomical change in the demands and the pressures on the financial institutions to provide specific services to members over the last 5 years than the collective changes over the previous 20 years. And why? For the same reason that Ms. Charles mentioned, people are saying, hey, I can do that with my Zelle. I can do that. Why can't I have that? That's why we have Mlajan. I can take my card and I can just tap and pay. Why can't I have tap and pay? No, we have to go get tap and pay. I can't have 24 access to my accounts. No, we have to have online services. And all of these things come at a cost. But the thing is, who in this road to relevance determines or rewards who does the work? It is ultimately the customer. It is our members. They are the ones that determine whether you're relevant. So if, for example, and the market is severe in terms of who goes home hungry and who gets to feed. If they perceive you, and particularly with the Gen X and Gen Z population, if they perceive you not to be relevant, technologically relevant, they will not do business with you. And we have for example, in the credit union movement now, where we become savings institution of choice, but lenders of last resort. We want to be lenders of first resort, but then our credit unions do not have such a high digital presence as the mainstream financial institutions. So we are playing catch up. So it may assimilate to that, but we need to interpret it within the context of the evolving dynamics of the marketplace. Now, as to whether the regulator needs to catch up, the regulator always needs to catch up. Will they ever catch up? Is a question to be thinking, because the way the dynamics of the marketplace changes. I mean, who would have foreseen we were talking about Bitcoin and all of these things about 3 or 4 years ago. Bitcoin never touched our shores. All of a sudden, within the last 2 years, we're talking about cryptocurrency and digital currencies and digital wallets and so forth within the space. And our people are saying, a lot of whom reside in the diaspora, they're saying, well, listen, if you don't have this level of service, we're going to go elsewhere. So we have to interpret this within the context of the evolution of the market space. And we also have to understand that no financial institution or no regulator would ever be on par with the market, because it is not the regulators of the financial institution that dictate where the market go. It's the evolution of the persons within the market space, our customers and our members. So it may look that way because the marketplace is dynamic. It's a dynamic environment. And that's why we have fintech company coming in. That's why we have MSBs. We never had MSBs for a couple of years ago, but all of a sudden now we have an MSBs, because just as the mainstream financial institution have to move and create, is like you have this big cruise ship that creates a huge displacement in the sea. Whenever they move off, credit unions are now forced to fill that void. And when credit unions move, the MSBs are forced to fill that void. So that is the evolution of the marketplace.
Thank you very much for those insights. And we take our final comment. We could be here forever because it looks like the field is really active. But the final comment, and it is for Mr. Belfield, and I think it's more of a comment than for further comment, but we'll see. the issue of the banking in Anguilla and Montserrat of credit unions are a bigger issue. For the local banks in the space, we too faced de-risking by our correspondent banks in 2017 and had to source and still continue to source alternative correspondent banking arrangements. Based on our current new correspondent banking arrangements, we are restricted based on the risk appetites of the correspondent bank. We would like you to be aware that both indigenous banks in Anguilla and Montserrat continue to lobby our correspondent banks, banking relationship and new relationships to allow for the onboarding of our credit unions and other affected clients within our markets. So I think this comment is trying to say to you that the banks in Anguilla and Montserrat, the indigenous banks, are still, exploring ways to which they can onboard credit unions and provide even further service and further collaborations. I don't know if you have one take on that before I do my wrap up and I hand over to Kevin.
I would never spare a thought on the issue affecting our smaller credit unions. And I appreciate the comment by the contributor in bringing some interpretation and additional information to the sector. We also need to be cognizant, and this is the thing that we have made specific reference to. The credit unions serve the same financial space that the banks serve. In fact, a lot of the investments and so forth, our affairs is a bit more constrained by the Cooperative Societies Act and the prevailing legislations. So if we look at it from the context, and this is a discussion that we've had with our local correspondent bank, which we enjoy an excellent relationship with. And in fact, we have actually done, and this is maybe something that the Bank of Anguilla and Montserrat and the other jurisdictions that have a similar situation can do. We, over the years, have worked collaboratively with National Bank of Dominica. So in fact, at some point, they used to provide risk training and AML training to our credit unions because they are also our bank of choice. So collectively, we have worked to enhance compliance within the sector because we see it as our collective responsibility to protect the financial space in Dominica. So, but the question I wanted to piggyback on is that if we look at it from the fact that the credit unions serve the same space or a subset of the space that is served by the banks in these jurisdictions, then it is easier to understand how relatively simplistic it should be to do more business with the credit union. So all I'm urging those financial institutions affected to say, listen, where there's a will, there's a way. And if we make the case for the inclusion of the credit unions, the case will be made. Because risk is not about something ideological, it is real, it is within the sector. And if we're serving the same subset, how can my member base, which is a subset of your customer base, be more risky if we're serving the same base? So that's just a question, pause for consideration.
Thank you very much, Mr. Belfield, for that. I'm going to give you all half a second, 30 seconds, half a minute. So 30 seconds to give you a wrap up and before we close. Very interesting panel. 30 seconds, Joanna. You're on the clock.
Thank you, Chair. I think, as I said earlier, I think in every crisis, there's an opportunity. I think we just have to be ready to be able to identify those opportunities and to take advantage of them. But I think there's need for collaboration. There's need for flexibility. There's need for us working more closely with our regulators to be able to overcome some of those challenges and come up with the right solutions. And as Phoenix said, the market drives, the demand for products and services. So there's need for that level of collaboration, even with the credit unions, to see how we can work more closely together.
Thank you very much. Wonderful. And Phoenix, you're on the clock.
Thank you very much. Thank you very much for the opportunity to be here, and kudos to the organizers. Again, from the credit union perspective, and I must reiterate about the symbiotic relationship between the EGRET and the COW. We have to understand that though we compete We complement each other. And we, as responsible financial institutions, we serve a bigger purpose. Some of us may be for profit, some of us may be for purpose or charity. But we serve a bigger purpose, which is to increase financial inclusion and access within the space and to protect it. And I believe that if we're to work synergistically with all players involved, MSPs, banks, credit union, regulators, ECB, we can achieve this and we can make this economic space a dynamic one. But we need to adopt the approach as the EGRET and the CAO of coexistence, mutual coexistence.
Thank you very much. That is a wonderful way to note. In fact, I actually had that as part of my wrap-up phrase, that we compete, but we complement. Because when we look at the COVID-19, we all know what it brought, but going forward, what were some of the lessons for COVID-19 for us? We saw the need for financial inclusion, because if you couldn't move and you couldn't get there, but you had to have access. And so that led to digitalization, it led to innovation, it led to the financial sector really coming together. But as we go forth, we see the need, as you say, the market is demanding more. And can one institution do it alone? Almost always the answer is no, because the cost is too high. And so the whole need for collaboration, the need for coming together. COVID-19 also saw, and we saw, and that is maybe one of the great advantages of COVID-19, a greater collaboration, coordination on working of the regulators and the regulated across sectors. We saw an expansion of even the inclusion or greater effort to include the credit unions and even other non-bank financial institutions, recognizing that that is important for, if you look at the strategic objective of the ECCB, one of it is payment modernization and financial inclusion. But all of that sits right back to what is our key mandate: financial stability, economic growth. And the financial sector is one of the biggest sectors for leading and spurring that growth, because it channels the resources. One of the largest mobilizers of savings is the financial sector. Social Security in our region is the largest, but followed closely by the banks and other non-bank institutions. And the question becomes, and Joanna raised it in her presentation, is it just savings for savings' sake? No. We actually have to move beyond savings for savings' sake to wealth creation. Because again, one of the key lessons from COVID-19 going forward is the importance of wealth, importance of having more than just a nest egg, importance of at least truly really working towards having at least a year's salary, so that you can, if a crisis comes, you are able to manage. Great, and again, something else, and Joanna said it, Belfield also said it, in terms of greater understanding of the needs of the people you serve, so that you can truly meet the needs of your constituent. And I want to thank you both for your fantastic presentation, but also in terms of your engagement with the questions and comments posed by our participants. And a big thank you to the participants for truly being engaged during these presentations. And with that said, I hand over, well, we end with that. We compete, but we complement. And let us think of the symbiotic relationship of the EGRET and the CAO. With that, I pass you on to Mr. Kevin Woods, who is going to close us off this afternoon.
Thank you very much, Dr. Henry, for so ably guiding the presentations by the panelists and the ensuing discussions. We are streaming live from the campus of the Eastern Caribbean Central Bank, headquartered in Bastia, St. Kitts and Nevis, and this has been the 4th annual conference with licensed financial institutions, titled an inflection point, what's ahead for the ECCU's financial landscape. As we conclude this morning's transmission, let me thank the management and staff of the Eastern Caribbean Central Bank for facilitating this virtual conference, specifically the governor for his introductory remarks. I'd also like to thank as well the panelists who so agreeably delivered their presentations this morning. Personally, Naomi Deali, Shari Joseph, Randy Graham, Joanna Charles, and Phoenix Belfield. I'd also like to thank the moderators as well, D. Tracy Polias, the Chief Director of Policy, and Dr. Valda Henry, the Deputy Governor, both of the Eastern Caribbean Central Bank. Finally, but by no means least, I'd like to thank the unsung heroes, those who are behind the scenes, behind the cameras, literally. In this regard, I'd like to thank the management and staff of the research, statistics, data analytics, management information systems, and corporate relations departments for their unwavering support in leasing their staff to facilitating this transmission. We certainly hope that you found this virtual conference useful in providing some preview of the necessary institutional and regulatory responses by the financial sector given the current financial landscape. I am Kevin Woods, your chairperson for today. Thanks for staying with us, and we hope to see you sometime next year. Bye for now from the Eastern Caribbean Central Bank.